struggling with just the survivability right now, as well as a little anxiety in there. So thank you for that. One more poll that I'm going to ask you, and this is just a chance to let us know what right now is keeping you up at night. The reason that we ask this question is it helps us deliver responsive programming based on what you need us to be bringing forward. So rather than us trying to predict the needs of our entrepreneurs, we simply ask the question, what do you need help with? So what you're going to help us do in this moment in responding to this poll over the course of the next 8 to 10 weeks, you'll see a number of classes, programs, and offerings that are dedicated specifically to the issues that you're raising here. So we've got a number of people that are responding around finance and scaling up the companies, also a number on sales and marketing. So thank you for all of your responses there. I'm going to go ahead and end that poll, and hopefully we will be able to share the results here in just a second. So again, thank you for everyone responding. Now, before we get started, I do want to take just a very quick peek for those of you joining us for the entire time today at the agenda. So if we can bring up that slide really quickly, we are going to see sort of an overview of what we're going to be covering today. We're going to be kicking off today's session with a market update and overview, and then we're going to jump straight into our first panel, which is obviously preparing for and staying on track for your IPO. We're then going to have a very quick 10-minute break before transitioning into our second panel for the day, where our panelists are going to be sharing a lot more details on executing your IPO, followed by one more 10-minute break. And then to round us out, our last session is really going to be covering achieving success as a new public company. So please note the same Zoom link will work for all of these sessions. So when in doubt, head straight back to the Zoom link that you're on today. Now, without any further delay, it is my absolute pleasure and joy to introduce you and give a very warm welcome to our first presenters to share an overview on the IPO market. Please join me in welcoming Pierre, Head of Equity Capital Markets Americas at BNP Paribas, and also Will, Director of Bank of the West at BNP Paribas. Hi, over to you, and thanks for joining.
Great. Thanks, Nicola, and thanks again to the whole team for having us on. Again, Pierre and I have now been on here for 3 different times over the last year. So I'm sure for those of you who are sort of repeat joiners, you may have seen us on here before. And so hello and good to see you again. And for those who are newly joining, it's very nice to meet everyone virtually and excited to really talk about what's happening in the market today. So if you think back to the last couple of times we've spoken in front of everyone, we spoke in May 2020, we spoke in December 2020, and now here we are in June 2021. And really, I think at each of those different times, the IPO market has been in sort of a distinctly different place. And so it's interesting to think about how the market has evolved from that time back in May 2020 when we sort of were in the depths of COVID and the market seemed like it was in a very difficult position, to December 2020 when things were feeling optimistic, to now when really we are really have seen quite a robust market so far this year. So why don't we start quickly by kind of rewinding to last year, as I think it does help to put into context where we are today if we think about what the market looked like last year. So if we could turn to the first slide, please. So 2020, obviously a very volatile year in both the market and other walks of life as we were dealing globally with the impact of COVID. But despite all of this, it was really a record-breaking and really an astounding year in the IPO market. So what we saw was 418 IPOs above $50 million, priced for $167 billion of proceeds, which is far and away the most prolific IPO year of all time. In fact, second place, if you go back and look, was 2000, kind of at the height of the dot-com boom, where we had around $103 billion of issuance. So last year really blew that away. Now, a large contributor to this was the rise of SPACs, special purpose acquisition companies, which I'm sure by now everyone is familiar with, if not tired of hearing about at this point. But last year we saw kind of the real surge in SPACs begin, starting after kind of May and June when things started to recover from COVID. And we ended up with around 85 billion or so in SPAC issuance last year, which was strong. You'll see this year we've had even more, and we'll get to that in a second. But that was more SPAC issuance than all previous years combined. So it really was the year of breakout for SPACs, and that certainly was a major factor contributing to that rise of issuance that we saw last year. But something else that I wanted to point to is even if you strip out SPACs, and SPACs have really gotten a lot of media and a lot of publicity, but if you strip that out, you'll see that even if you were to look at only traditional or regular way non-SPAC IPOs, it would have been an astounding year for those IPO for that as well. So, what we had was circa 85 billion or so of non-SPAC deals, and if you again go back and look at the history, that would have placed it in really the top 5 of all time, again for IPO volume, and that's looking only at regular IPOs, only at non-SPACs. So I don't want it to be lost in the weeds that yes, SPACs have obviously gained a lot of traction as a route to go public. There's been a lot of issuance, but a lot of companies are also going down that IPO route, the regular way IPO route, and have been very successful, and it's been very prolific. So you can see at the top right hand of the page, some of those companies last year were pretty well-known names: Airbnb, DoorDash, Snowflake. The largest deal actually fittingly was a SPAC deal for Bill Ackman's Pershing Square Holdings. But a couple other things I wanted to point out about last year was the fact that healthcare and technology issuers continue to dominate. Again, this is not something that's unusual. Generally in the last 5 years or so, if not a little bit longer, we've kind of continued to see tech and healthcare be the largest component of the IPO market. The vast majority of deals were primary, i.e. the proceeds flowed to the issuer itself and not to pre-existing selling shareholders. The average deal size was around 492 million, with the median being 245. So the average deal is maybe not as big as you would think, but a couple of these very large jumbo deals, like you can see on the top right, sort of increased the average size. And aftermarket performance was exceedingly strong, perhaps much stronger than we would normally see in a regular IPO year. And I think this was due not only to the merits of each company on its own, but the fact that the market as a whole was really recovering from the drop that it saw after COVID. So it made for very positive aftermarket performance, which kind of fed the virtuous cycle of more deals coming to market. And the last thing I'll say about 2020 is, when we were doing this presentation a year ago in May 2020, we'd only had around 18 billion of issuance so far, and things were still feeling pretty bad with COVID. So what's even more remarkable, perhaps, is the fact that 140 billion plus of those deals which came last year came from June through December. So pretty remarkable resilience and recovery of the market. So let's move on to the next page. Can we, thank you. So when we spoke at our last IPO market update for the Bootcamp in December 2020, I think we felt pretty optimistic about where the market was going. We're coming off the end of a record year, but I would say I would have been perhaps surprised to see or to guess that we'd be at where we are now with such a strong start to 2021. So again, remember 167 billion of issuance in 2020. We're only just through the end of May in 2021. And what we've seen so far in 2021 year to date is over $164 billion of issuance. So we are essentially right, almost even with where we were at the end of 2020, and we're not even halfway through 2021 yet. Now, this has partially been driven by perhaps the peak of SPAC mania, and we'll talk about that in a little bit, in Q1 2021, where we had, and so far this year, we've had over 100 billion SPAC issuance, which has already surpassed the full year for SPAC issuance last year. So that is certainly obviously a big component of the surge of activity that we've seen so far in 2021. But as I highlighted in 2020, I'd like to kind of re-highlight for 2021 year to date that this continues to be a pretty strong market, even for what I was calling the regular way traditional IPO issuance. So we're at 61 billion so far of the traditional non-SPAC IPO issuance. Again, that would already put, if the year ended today, that would put this year in line with the top IPO years of all time, which were, are somewhat behind the top IPO years of all time, which were 99, 2000, 2014, and 2020. And if you continue at that run rate, again, excluding SPACs, we could exceed all of those years. So we could potentially see a year where again, if we continue at the rate that we've seen so far, we would surpass 100 billion of non-SPAC issuance, which would stand alone be the best IPO year of all time. So it really has continued to be a strong market. We've continued to see some large deals, top right, maybe not quite as known names perhaps as some of the deals that came last year. But what we have seen that kind of differentiates 2021 year to date from 2020 is the aftermarket performance has been somewhat softer. Again, we were coming off of a very high base last year where we saw just stellar aftermarket performance buoyed by that secondary market recovery at the end of COVID. And so it has dropped off a little bit this year. You can see some of the marquee deals like Bumble up only 5% since the IPO, where if you remember from the previous page, both DoorDash and Airbnb were up 100% plus from their IPOs. So it's been a little bit more muted. That being said, it's still positive. It's still generally strong. And we haven't seen any tailing off of new deals coming to market from the issuer side or from investor demand due to the fact that we're having slightly more muted aftermarket performance. So that's a good segue into the next page where we'll kind of talk a little bit about what the major drivers are that continue to drive market strength. So if we could turn to the next page. So what's continuing to drive continued IPO market strength? So I talked about aftermarket performance, and I think that's probably the biggest factor. And you'll see both the bottom left-hand chart and the bottom right-hand chart are kind of highlighting different aspects of the strong IPO aftermarket performance that we've seen. And you'll see kind of in the trend from 2020 into 2021, you'll see the data kind of reflecting what I had mentioned about the fact that 2021 has been a little bit softer in terms of aftermarket performance. So in the bottom left-hand chart, what we have here is the comparison of the Renaissance IPO index, which essentially incorporates all new IPOs above a certain size into that index, versus the kind of main secondary market indices that are used for comparison, the Nasdaq and the S&P. And so you can see that measuring from the start of 2020, the IPO market index continues to outperform both the S&P and the Nasdaq pretty strongly. We're at about 100% gain for the IPO market index versus 54% for the Nasdaq and 31% for the S&P. So again, you can look at kind of that chart and you'll see towards the end of 2020, we really hit a huge degree of separation from the secondary market as a whole. And then the IPO performance has come back a bit, but it still continues to be strong and still continues to provide that alpha for investors above and beyond the secondary market. And again, on the bottom right, you'll see really in March and April, that secondary market performance dropped off a little bit. This is 1 month performance, by the way, so that's why we don't really have anything for May yet. But you'll see it dropped off a little bit. Again, quite positive, over 10% average performance for the IPO just in the course of a month. So, perhaps by measuring against other years, besides 2020, which was one of the strongest years of all time, it would be considered still quite a strong market. So from what we're hearing, what we're seeing in the market and with new deals coming, investors continue to be interested in new deals. They continue to generate alpha, even if they're perhaps displaying a little bit more selectivity on new deals due to the more muted performance. And the other factor that I wanted to talk about is the VIX index, which also is a good contributor to IPO market strength when it falls, and when it's below around 20 or so is what we use as a typical metric for what we view as being a very stable market. So what we saw back in 2020 was the VIX spike to above 80 and slowly dropped throughout the year, but never really passed below that 20 metric until this year. So it wasn't necessarily a hindrance to deals coming to market last year, but the fact that we've hit a level below 20, it was around 18 when we made this presentation at the end of last week. We think that's a very strong factor, and we think that's going to help investors continue to feel comfortable going into new deals. So if we can move to the next page. So I wanted to talk a little bit about, and this is a similar page that we've included in previous decks if you joined the last May or December presentation, but wanted to touch again on some of the impacts of COVID on the IPO execution process. We're all hopeful that we're really coming out of COVID and moving back towards, normalcy. But I do think some of the effects that COVID had on the IPO market in one way or another are likely to remain in the IPO market going forward. So the first one, and probably the most obvious, is the move to virtual roadshows. Pretty much everything continues to be done fully virtually, even as we start to come out of COVID. From all of the deals that we've been on and from what we've heard on other deals, it's something that's been quickly adopted by the market. It's something that's been quickly adopted by investors that, perhaps prior to COVID were even more traditional and focused on face-to-face meetings. They've quickly adopted as well the willingness to do virtual meetings. So that's something that I think will stay in one form or another. I could very well foresee a scenario where we have a sort of hybrid roadshow that becomes standard going forward. And it'll be interesting to kind of see where it goes. But I could foresee a scenario where you would perhaps visit some of the top potential accounts investors in New York and other major cities in person, whereas some of the, instead of going to Europe, as you perhaps would have done in Europe and Asia and doing an international roadshow, maybe depending on the issuer, you would just do those meetings virtually. So I could foresee that as being something that happens going forward. And then a sort of knock-on impact of doing things virtually has been a move to shorter roadshows. So you can see here on the top right-hand side of the page, we have a chart of the average roadshow length per year in number of business days over the last 6 years or so. And you can see that when COVID hit and things went virtual, it really did drop. It dropped essentially by half from an average of a little over 10 days to around 5 days last year. And that's because doing things virtually really allows you to cut out a lot of dead time where you would normally be flying between cities, traveling between meetings, stuck in traffic, whatever. You can cut all of that out by doing a virtual roadshow. It is interesting to see that we've seen a little bit of an uptick in 2021 year to date. That's not because things are moving back to physical. I would say that's perhaps an impact of the fact that volatility has fallen, whereas last year when you had a high VIX, I think some issuers were eager to kind of get the deal done as quickly as possible because the more days you're out in the market, you're potentially at risk of having a really volatile day that could kind of spook investors a little bit. I think now that the VIX is down below 20, people are a little more confident, spending a little more time out there, making sure they're being very thorough about talking to the largest number of investors possible. It's a minor uptick, but I think perhaps the lower volatility has something to do with that. Cornerstone anchor investors is interesting. That's something we really saw come into play in the U.S. If we could go back to page 5, please. Yeah, that's something we really saw come into play in the U.S. last year. Again, in this period of COVID-induced volatility, having a cornerstone investor essentially announced at the time of an IPO launch that they were going to be a major investor in that deal sort of gave more certainty to the fact that the deal was going to be executed. This, by the way, has been something that's been a staple of IPO markets in Europe and Asia for a long time. It hasn't caught on as much in the U.S., but we have seen it continue to some extent. One major example of this was the Oatly deal, the large oat-based dairy producer that went public last month. That was a $1.6 billion deal, and they had Bally Gifford named on the front page of their prospectus as a cornerstone investor. So that it does continue on select deals, not by any means the majority of deals, but it is something that we are seeing in the U.S. now. And then finally, the SPAC trend really took off last year kind of on the back of COVID. I think it was seen as something that provided a little bit of a hedge against volatility, provided sort of a cash alternative with an equity upside for investors. So it worked well in a volatile market where investors were happy that, yes, they could perhaps participate in upside, but they also had this sort of back-end put if things went wrong. And so that took off last year, and it has continued to an even greater extent, really, in 2021 year to date. So $82 billion last year, again, was more than all the previous years combined. But here we are at, June 2021, and we've already surpassed full year's SPAC issuance last year. The majority of that was in the first quarter. We're about to get to it on the next page, but that substantially dropped off in the second quarter. And a big driver for that has been a couple of concerns that have emerged that I'm certain many of you have read about in the news. There have been concerns about oversupply and oversolicitation of PIPE investors, which typically come in at the time of the business combination, aka the de-SPAC, as it's sometimes called. But then more technically, we've also seen some things come out on the accounting treatment of embedded warrants, about whether they should be treated as a debt instrument instead of equity. And then the SEC had put out some statements about the use of forward-looking statements in conjunction with a de-SPAC, which had previously been touted as a potential advantage to a traditional IPO. I think people are having to be a little bit more cautious about those now as well. So I think all of those factors combined sort of led us to reduced issuance in Q2. So that's a good segue to the final page here. If you can move on to the next page. Yep. So, well, we'll start with number 3 since we're already on the SPAC topic. But you can see on the first chart here at the bottom of the page, $97 billion of issuance in the SPAC market, nearly 300 deals in Q1. That dropped precipitously in Q2 with only around $7 billion of issuance and 30 deals. So again, those 3 factors, kind of the supply-demand factor, I think the warrant factor, and the forward-looking statement factor all sort of had a play here. So I think there's been a lot of debate kind of as to where the SPAC market is going, and that's perhaps a bit beyond the scope of today's presentation. And I believe the center is doing another presentation at some point on SPACs, so that could be interesting to join. But it is interesting to think about where it's going to head now. I don't think we'll see another quarter with $99 billion in SPAC issuance, but I do think it will remain some part of the IPO market going forward. Another interesting point to think about is the de-SPAC activity or the business combination activity. You know, that has continued to be quite strong. And I think, you know, you have to remember that the vast majority of SPAC proceeds that have ever been raised have just been raised in the last 12 months. And there's a lot of capital out there that's been raised by SPACs that is still in search of a target, over 130 billion that's still in search of a target. So I think even if SPAC issuance kind of levels off, we're going to continue to see a lot of de-SPAC activity in the coming quarters. And we saw over 234 billion EV of deals announced in Q1, 124 billion in Q2 so far. And I think that will continue as you have a lot of, as you have this 130 billion plus in search of a target. So that'll be interesting to watch. And I think one other interesting thing to watch with it when it comes to companies coming out of the de-SPAC and becoming public companies, you know, they don't necessarily have the same number of banks as you would have in an IPO working on that deal. With an IPO, you have a large syndicate of banks that some of them will start to cover from a research perspective, and some of them will start to make markets in that stock after the IPO. You don't necessarily have that for a de-SPAC company. So we don't have that many examples now because it's so new, but I will be curious to watch kind of how the liquidity and research engagement compares to de-SPAC companies versus those that went through a traditional IPO. I'll just touch on 2 more trends briefly for 2021 year to date, and then I think I have 1 or 2 questions. The emergence of IPOs, which highlight either pure play ESG sustainability or some angle of that, I think continues to grow. You're seeing more and more people talk about that in prospectuses. We have 2 examples here on the top of the page for Oatly and Scholl's. And then secondly, the development of the direct listing market. Some may say this is not a real IPO because you're not raising proceeds, and it's still a small part of the market. But we have seen it start to move maybe a little more down market with smaller companies like Squarespace and ZipRecruiter taking advantage of it, whereas before you generally saw larger, more well-known companies. So I'll pause there because I know we have 2 minutes left, and maybe I can take 1 or 2 questions. So let's see. The first question, are you recommending that clients push for an in-person roadshow or go with virtual? You know, from my point of view, I think investors have fully adopted the virtual model. So I don't think there's necessarily any advantage right now to doing in person. I think as things open up more, maybe there will be a slight advantage to seeing 5 to 10 of the top prospects in person if they're willing to, but I don't think anyone's going back to a physical roadshow. I don't know if Pierre, you have a view on that one.
No, I agree with your view. I think maybe what we will see in the past, in the future, with the hybrid model, will be effectively few very top targets in terms of institutional investors will have a physical roadshow because they still want to see, you know, the management of the company in their eyes. But I think the efficiency of the virtual roadshow will certainly continue to be there because it's so more practical in terms of time saving, in terms of numbers of meetings you can jam in the roadshow time.
Yeah. And I think we have maybe time for one more question because we have 1 minute left. The next one was, can you comment on whether the SEC is trying to address outlier issues like companies with limited revenue, i.e. electric car producers, with their guidance, or whether they're trying to address the whole potential SPAC market? In my view, I do think a big part of it is companies like that were sort of using very aggressive forward-looking projections that were not necessarily reflective of, it was a zero revenue company that was projecting revenues 5 years out, which is very tough to do. So I think it was sort of targeted towards that, but I think it will in a way affect the rest of the SPAC market as well. I don't know if Pierre, you have a quick view, and then I think we're out of time.
I think it's really what the SEC wants is to have more discipline in terms of using forward-looking statements. And I think the market will adapt. It just means on the paper, this SPAC won't maybe be as promising as they are today with the projection we are used, because you will be forced, like in a traditional IPO, I would say, to be a little bit cautious about the projection you're using. But the market will adapt. I mean, that's it. I mean, you have so many vehicles out now that certainly you will find other de-SPAC deals, but maybe with a little bit more discipline than what we've seen in the past few months.
Well, thank you both. That was always amazing to learn the most recent information and updates. Really appreciate Will and Pierre, you joining us today. And up next, we have a continuation of experts joining us. Our panelists now are going to be covering a lot of information around preparing for and staying on track for your IPO. So please join me now in welcoming our moderator, Michael, partner at Wilson Sonsini, Sherry, partner at KPMG, Priya, partner and senior vice president at Woodruff, Sawyer, and John, general counsel and secretary at Paymentus. Team, over to you.
Great, thanks, Nicola. Again, I'm Mike Morbett. I'm the head of the capital markets practice at Wilson Sonsini, and we think of ourselves as the premier law firm serving the needs of high growth companies, particularly in the technology and life sciences space. Sherry, you want to share a few words about yourself and your practice?
Yeah, sure. Thanks, Michael. Hi, everyone. My name is Sherry Major. I'm a deal advisory partner at KPMG. As many of you probably know, we're an audit, tax, and advisory firm. And my area of specialty is around capital markets transactions and M&A transactions with an accounting and reporting focus. So my team and I help companies get ready for an IPO and for life as a public company. Priya, let me hand it over to you.
Thank you, Sherry. I am Priya Huskins, a partner at Woodruff Sawyer. We are a full-service commercial insurance brokerage, servicing clients worldwide. We are particularly well known for our D&O insurance practice and are the unquestioned leader when it comes to helping companies go through their public company process, be it SPAC, de-SPAC, IPOs, or direct listings. John Morrow, over to you.
I'm John Morrow. I'm the general counsel of Paymentus. I feel like I need to be a partner because I'm like falling behind in titles here on this great panel. Lucky to be here. So I'm general counsel of Paymentus. We're a fintech company. We went public. Just finished our IPO. Closed our first day of trading was 2 weeks ago, literally. So I'd say this is relatively current. I've been at Paymentus for a little over a year, and before Paymentus, I was general counsel and led corporate development at Aptio, which went public in 2016. So I've done this twice now. I'm not sure I can survive. I'm getting old. I'm not sure I can survive a third, but hopefully can add some value here to the panel. So I'm looking forward to this.
John, I think you probably have at least 2 more deals, and I think you need to go for a direct listing and a de-SPAC before you hang it up. So thanks everyone for joining today. We'll just kick it off. Since the topic of the panel is preparing for the IPO, John, maybe we'll start with you. How far in advance would you recommend folks to start thinking about getting prepared for the IPO process?
So I'd recommend thinking about it as far back as you can. I mean, I know that sounds stupid, but you'll benefit by being intentional about the process, say, a year to 2 years even before you're really ready for going public, because there's a bunch of things you may decide not to do, but that you should start to do. I mean, Sherry can speak much more articulately on this than I do, but pretty much everyone who's ever done an IPO will tell you the thing that will trip you up almost always tends to be in accounting and financial reporting, just because the difference between private and public is so high. So you can start, you should have lawyers who understand an IPO. If the years where your lawyers did all your venture financings and then did all the work on your IPO, I think those days have been gone for 5 or 10 years. So your team will start to transition. Your audit team may start to transition. You'll start to have a very different conversation with your D&O brokers because the costs and structure are radically different. So I think, if you go back a year or two, you'll start particularly on the accounting side, things like reporting, doing quarterly. Do you evaluate doing the quarterly work, which always seems to uncover all the bodies? You start to elevate your audit work to PCAOB compliance. You don't have to do it all, but you can start to chunk it off. Your audit firms can be great partners with, they can do things that do not create conflicts, independence issues for them, but can help you with evaluations that are usually pretty reasonably priced in the context of IPO advisors, and but can help you evaluate your readiness from a reporting and other perspective, because it's things like IT controls that don't even occur to you to be ready for an IPO. So I'd say starting back, you don't have to do it all. You just have to know what all the pieces are. Who are your advisors? Do you have the right team? Do you need to transition your team? Starting the hiring process. It's just, you can't decide 6 months before you do an IPO to start doing an IPO and go public in a fast time. All the prep work enables you to go very fast at the end, or you can start the process late and your process will just be fairly slow.
Sherry, from your perspective at the accountants, how would you answer that question?
Yeah, so John, I need to bring you to all my client meetings because you are talking my story. So Michael, we typically are telling our clients that, 12 to 18 months is that right time to start thinking about it. And it will very much depend on the maturity, of the company and their life cycle. But as John mentioned, at least be thinking about what you need to do. You might prioritize things differently. And the way we look at it is around sort of 3 key areas. And, accounting and reporting is one of the primary things. We always say it's the long pole in the tent when it comes to getting ready for an IPO. And it's accounting, it's financial reporting, it's tax, it's management reporting. So there's quite a bit that, a company needs to get their house in order with respect to. The second area is corporate governance. And I know Priya can certainly touch on that as well, but it's thinking about boards and committees and policies and procedures and, thinking about what SOX is going to look like. There's runway for getting ready for internal controls reporting, but it is something that takes a long time. And so thinking about how you're going to approach that is really important as well. And then the third area is just around people, process. There are going to be some key hires that are necessary, and it's thinking about what's the right timing for that. If you're going to be transitioning, IT systems, that's not something you want to do in the middle of an IPO process. So it's like, do we do it before? Do we do it after? Is what we're on today sufficient, from a controls perspective and a, reliability and accuracy point of view? And then just process. The earlier you can behave as a public company, the easier that transition is. So whether it's accelerating your close process, focusing on budgeting and forecasting, there's so many elements that are more about the being public than the going public that are just so important to start practicing and getting ready in advance. So those would be the areas that we advise our clients to start thinking about early and prioritizing. And I'll tell you, I have worked with some that have only started thinking about it 9 months or 6 months before. And that can be very challenging. So you want to pull forward what you can that's going to help you in the long term so that you're not, bombarded with, all these other tasks that are going to be competing with your time as you're in the middle of an IPO process.
Yeah, Sherry, you picked up on something that John mentioned. Like you can't sort of wake up 6 months before an IPO and just that be the first time you think about it. I've been involved in situations where it feels like that's actually what happens, and particularly right now in the current environment where you've got other options other than a traditional IPO to go public, specifically the de-SPAC approach. And Priya and I have talked about this in other contexts, but one of the points that people say about de-SPAC transactions is that it allows you to go public faster. I think a lot of times people think that that's the transaction process somehow is faster, which I'm not really sure that it is. I think it is true that people can access the public markets sooner than they might have otherwise done, pursuing a traditional IPO. And so when you have clients who are thinking about a de-SPAC transaction, it might be in that 3-month window or less, or the 6-month window or less than 6-month window, and decide they want to go public that way. What are some of the things that they can do to catch up, to be able to be ready, or as ready as they can be by the time they hit the public markets?
Yeah, so I think, the key things to focus on if your window is short is really going to be around the financial statement and the regulatory requirements of doing the IPO itself. Some of the things that are more impactful around being public, there will be some decisions to make because they won't be able to focus on everything. But, meeting those regulatory requirements in an S1, so anything around financial statements is going to be key. When it comes to process, they might need to rely on some advisors, for extra bench strength, right? That might be one of the solutions to deferring. Maybe you don't get the hires in place that you really want, and so you're relying on outside support. Maybe you're making a decision around technology that isn't the ideal solution, but you could get there for maybe a few more quarters and then, do something different down the road. So it's really about prioritizing what is an absolute must for the IPO itself. And then how do you sort of make things work on the things that you can delay a little bit, but not too long, because you just don't want that risk as a public company. You're in the limelight. You don't want to miss a reporting deadline. You don't want to have, an error in your financial statements. You don't want to miss your, earnings guidance, things of that nature. So those quickly become very important as well.
Yeah, and that's everything you said totally resonates with me in certain circumstances that I've seen, and people who decide to sort of take that approach, you tend to have to throw a lot of people and a lot of resources at the problem in order to catch up. Priya, I think Sherry also mentioned sort of the corporate governance part of it as well, and one of the things that we with our clients we talk about early and often is sort of board composition and attracting good people. I mean, can you maybe comment a little bit about how you guide your clients to think about those issues?
It's a great question, Michael, and I think it is a place where people can be terribly surprised. The amount of time it takes to recruit a high quality audit committee chair cannot be overstated. And here's something funny. The really good audit committee chairs will absolutely not join your company with 3 months to go till you start trading as a public company. They're not going to be comfortable. They're not going to want to do it. They will stop returning your phone calls. So a really good tip is if particularly in a world where maybe the management team has less public company experience, and you're going to try and offset that by having a board with more public company experience, those board members take longer to recruit. And that goes double, if not triple, if you're looking for a diverse candidate. And at the end of the day, you're not going public without your independent directors or super close. So that is something that I can't stress enough. And I'll just say now that if you want to be the audit committee chair of a new public company, go ahead and send me your resumes right away. There's a big need.
Yeah, and CC me when you do that. So appreciate that.
100%.
Yeah. And this is something also that John mentioned earlier. You sort of alluded to is the D&O process. Mm-hmm. I mean, how far in advance is that something that people should be thinking about preparing for that type of thing?
Yeah. So there's a theme here, which is everything feels better if you start earlier and have a longer runway. And all of the advisors on the panel have done it in a shorter amount of before a renewal cycle. So think 12 to 18 months before your IPO. And first and foremost, you really do want to choose the right insurance broker. You may have been working with a broker that is doing a super fantastic job, having supported your company over a lot of different disciplines. It is different to do D&O insurance for a public company. And it's actually a special skill set to get you through the public company window. There is a naive view that it's the same insurance product. So first of all, that's just not true. And the nice way I'll put it is that D&O insurance carriers don't make money for their shareholders when they pay your claim. So there is real skill in getting the right terms and conditions into the policy. But let me also say, particularly at the prices people are paying, if all you got was a product, you missed the boat. A good insurance broker isn't just selling you a product, they're providing you with counseling and a level of service that's very meaningful in a high stakes environment. So the thing to remember is, if things go wrong, you're looking at basically unlimited personal liability for the D's and O's. And so that's why you want to think about who's your broker and how can they support you well in advance. It's very likely that if you are the kind of company or executive that's attending this program, you're the kind of company or executive that's looking for high quality advice. That's why you sign up with a KPMG and a Wilson Sonsini. D&O insurance isn't somehow lower stakes. Turning to just some of the blocking and tackling, one of the things that a good broker can do if they have visibility into your plans is start socializing your company and your company's risk with the kind of insurance carriers that are likely to be part of your program stack, your insurance program as you're going public. It is really good to have some time to socialize the company before you absolutely need the insurance, right? Because it's axiomatic. You're going to have this insurance in place before you start trading, and your leverage just continues to go down as you get closer to that date. So that's why we love the long timeline. Very specifically, though, the starter gun for arranging the D&O insurance for the new public company is the filing of that first confidential S1 registration statement. And I did say the confidential one. So a good broker is in the market about a week or 10 days in advance, arranging NDAs with the worldwide insurance community so that they can send that registration statement through, start arranging underwriting meetings, and the process goes from there. The last thing I'll mention is, like everything else, you're going to just get busier as you get closer to the first trading date. So to the extent you could spend some time before you're sending the S1 through, even perhaps before the org meeting, could spend some time with your broker understanding the landscape and some of your program options. That will save you time and frankly help you and your board be much more efficient later in the process when you have less time.
Yeah, thanks, Priya. And I just to echo some of those points. I mean, it really is an important part of the work streams for going public, regardless of what path you particularly take. And it is there is a certain amount of cost associated with it, and you really want to make sure you're getting value from your broker and people like Woodruff, who can help provide that advice and advice in other areas like taking a look at your indemnification agreements for your D's and O's. I mean, those are the types of things that can really differentiate a really good broker like Priya versus someone who you may not feel like you're getting as much value.
Yeah, and I maybe just from a purely nuts and bolts, I completely echo everything Priya said. I think is even if you think what D&O insurance costs and you knew what it cost 5 years ago or 10 years ago or even 4 years ago, it is shockingly expensive. Deductibles and retentions are shockingly high because of the risks the carriers, all the state law claims that people can bring are really causing the exposure. And so I think to Priya's point, like these orders of magnitude more than it cost 5 years ago, and it's like enough. The numbers are enough. It's good to have that. I'd have that discussion with your broker, whatever. You don't have to be pinned down to exact numbers, but see the benchmarking, see some comparables, so you can have a conversation with your CEO, with your board, with your CFO, because it is enough. The numbers are enough that it will materially affect your profitability profile for your financial model. Like you whatever number you think it is, it's probably 5x the number that you think it is, and that's just and a good broker will help you get great coverage and save money, but it's probably more about getting the coverage at the end of the day than the money. So I would echo that. And then to Priya's other point on board members, I would echo that. I think it takes time to find good board members, and there's a discussion if you have an investor controlled board, which many of us do, and how do you think about adding board seats? How do you think about transitioning people, or do they transition off? Are they going to transition off after the IPO, before the IPO? Add a seat. There's a lot of real discussions there, and there's a lot of competition. I think the SPAC point, if you think of, there's not that many IPOs, how many people can want a board member? Well, all the late stage unicorns want board members who are qualified to be public company board members. Every SPAC needs board members. And all those SPACs are chewing up a lot of the board members. The positive thing, though, I think from a board member perspective, relative to Mike, you could speak to this, like, relative to 10 years ago or 20 years ago, I've been doing this for a long time. 20 years ago, 10 years ago, if you looked at a board, you wanted an audit committee chair who'd been an audit committee chair before, maybe a partner at an audit firm. That probably, frankly, hasn't changed very much. But across the rest of your board, as you add other board members, you were really looking for former CEOs and maybe CFOs. And that's a pretty public companies. Like, that's a pretty narrow group. I think the positive thing now in looking at board members is, you see roles that you didn't see 5 years ago or 10 years ago, CIO, CMO, people who are maybe first-time public company board members. And that's, I think, a great market trend. The problem is most of those people can only do one board, not 5 boards. And so I think it makes getting those people, and everybody's after the same people. So the pool's broader, but there's a lot more people. The SPAC impact on board members should not be underestimated, because there's just a lot more people being consumed than I probably would have expected.
Yeah, I mean, that's a great point, John, in terms of the sort of attracting the right people to the board, and that's a very important dynamic, and kind of an impact within the boardroom, and also on the management and how its day-to-day life goes, and spending enough time to get the right person, as opposed to someone who ticks a particular box for the Nasdaq listing requirements, is really, really important. And there's real value, I think. There are some situations, typically with founder-led companies, where there's a certain reluctance to loosen the reins. With those folks, I really try to spend time, talking about all the good things that are come, with having people with perspectives in different areas of the business that can really add value. And once you sort of get people over that conceptual hump, they really can embrace that dynamic. But again, it takes time. Okay, so shifting gears from the timing part of it, Sherry, I just want to touch really briefly, and we talked a little bit about sort of variable costs that you might bring in from an execution perspective, but from KPMG's seat, as you think about the team that you're going to be working with as they go forward public, what are sort of the key hires that you want to make, if they're not there already, that you want to make sure that they're in the seat and operate at a high level?
Yeah, absolutely. I mean, I do think it's important to have public company experience at that CEO, CFO level, at least one of the two. So that's certainly something to think about if that's not already in place. And, sometimes that's a difficult transition to bring in somebody new in advance of an IPO. So thinking through that early and that right transition time. And if the CFO doesn't have the sort of accounting and reporting experience and is more, finance oriented, which is very typical, having a really strong chief accounting officer or corporate controller who's that CPA is another potential important hire if they're not already there. And I think it's important not to underestimate, the need for that experience. A couple other areas, SEC reporting, technical accounting is a key hire. Someone can play both of those roles. And I think, that's a good mix of skill sets. Sometimes we see SEC reporting, technical accounting also play a role from a controls and a Sarbanes-Oxley perspective. So there's some interesting ways to hire those skill sets in-house. I will say they're very much in high demand. And so it's important to try to get them in early. And, I've heard companies say, well, we don't want to have a job description out there that says SEC reporting, because then everyone's going to know we're looking to go public. And so there are ways of looking for those folks, more from, say, a technical accounting perspective without maybe tipping your hat. But they're helpful to the drafting of the S1 process. They're helpful to getting the technical accounting and reporting issues documented and through sort of PCOB audit. So sometimes it's a balance. Do I bring them in, too early? What if we ultimately, don't do a transaction? I think they can be very helpful to the process. And so that's not a hire that I would worry too much about bringing in too early. They'll have skill sets that I think are important to the finance function. I alluded to SOX and controls. That's a full-time job, and it's not something the CFO and the CAO want to be focusing on top of everything else. So if you can bring in someone that has that expertise. Now there's more timeline permitted to get ready for controls compliance. And so that can be a hire that comes a little bit later in the process, but I would say sort of as you're about to go public is a good time. There will be some minimal requirements, not really requirements, but I'd say best practices from a controls perspective around, having a plan in place for how you're going to get there. You have, potentially 1 to 2 years to become SOX compliant, but it is a long journey. And so you don't want to wait too late for that hire. And then I would say, ahead of tax, if you don't have one already, lots of companies are outsourcing tax, which is a model that's completely appropriate even after you're public. But I do think you want someone in-house that has that expertise. And so that's typically an area we see. And then finally, investor relations, that will also become a full-time job. And same thing, you might outsource to, an IR firm, but having someone who's tagged in-house to play that role, I think is important as well. And then we see, roles around, technology, if it's a technology company, you might want a CIO if you don't have one yet. So there's, a number of roles that will become important, but I think the ones that I mentioned are probably the key ones that pretty much every company, needs to be thinking about.
Yeah, John, anything that you want to add there, particularly maybe on the IR question, because I that's the one that I get a lot, whether you go with an outsourced firm or bring it in-house. I mean, you've done it a couple of times. Any advice you want to offer there?
Yeah, I think frankly it depends. How's that for lawyerly response? I think it depends on, what does your CFO want to do? What's your CFO gonna do? Do you have FP&A capabilities that'll cover some of the ground in IR? Do you have someone with experience or not? I think you're prudent to have it, but it can be really hard to recruit those people until you get more in the hopper, right? If you get a great IR experienced person 6 months or 12 months before your IPO, they're not really going to have that much to do, and you're going to have a hard time recruiting them. They're probably one that's easier if you waited until 3 months before, or even maybe once you've started in the hopper. But I think there's only so much of that work you can outsource, though. Like, somebody has to pick it up. CFO, FP&A, maybe it's even an analyst person who there's coordination, there's follow-up, there's who you're testing the waters meetings with. So like, somebody has to do at least part of the job. You can lean on IR for a lot of it. I would say having an IR firm or an IR background, as you're starting the process is pretty useful, because everybody tells you they're going to help you. But I think practically, a lot of the transaction-specific advisors kind of disappear, after the IPO or after your first earnings call, and then you kind of go, crap, like, what do I do?
Yeah.
So.
Yeah, and just following up on that, John, I'm sort of thinking about advisors, and I've stolen the joke that you've done many times that, when I hang this up, like my next job is to be a consultant to manage all the consultants for going public.
That is what I'm doing next time around. That's my next job. So.
But seriously, I mean, as you like, there are a lot of people who want to be there to be helpful, to take you through that process. Like, what are the differentiating factors for you as you look to build a team of external advisors? What are things that were important to you?
So that's a great question and complicated. I think, first order question is probably looking at your own team internally and what do you know, what do you not know, and where are your skill set gaps, right? Do you have IR experience? Because can you, cover that? Do you have FP&A and analytics experience? You kind of need that no matter what, because there's a lot of analytics that nobody else can do for you about your business. So, and then your core team, the people you have to have a D&O insurance broker. Like, you must have one of those. You're in a world of hurt if you don't. And if you need a new one, because you have a local broker who's never done an IPO before, you know what? Go get a new one. You need lawyers with IPO experience. Mike, I've worked with you twice, so I think that's but you need a team at your law firm with IPO experience. That may need to add a person or two. Your lawyers should be keeping an eye on that for you. But if they haven't, do that. And you need an audit firm with, you have to have company counsel, you have to have an audit firm, and you really have to have a D&O broker. And your audit firm should be somebody who has IPO experience, and ideally a team with IPO experience and IPO experience in your space. One miscellaneous side note, lessons learned. If you are a controlled company, so if you have one majority investor, like a private equity sponsor-backed company, have a real conversation with your auditors about it. There are some very weird rules in independence that conflicts from other portfolio companies can be attributed to you. and they're not easy to resolve all the time. And it's not your audit firm's fault, but if somebody's not thinking about it, they may not have run their conflict checks and that kind of thing. So, so that's just a miscellaneous thing. But people who don't know your things, a team that knows your things, and sometimes that's why you can start a little early. You'll start adding in a new person to your audit team, maybe who's got public company experience. Mike, somebody like you, or your team kind of transitions into a normal venture-backed team. So those are your core advisors that you have to have. Then I think there's a real question. I'd suggest doing some homework and talking to people who've done IPOs in your space, because there's a lot of different permutations of, do you want or need an IPO advisor out there at all? Are you gonna run an RFP process for your banks? I'd recommend it. Even a lightweight process keeps everybody honest and sort of gives you some leverage in negotiating the economics. But there's IPO advisors who are standalone IPO only advisors, kind of boutique firms usually. There are IPO advisory services provided particularly by some of the investor relations firms that can be pretty valuable. The accounting firms have some of that, although they have to walk such a line. I think it can be tough for them to be super involved in the process, but they can help you in parts of it. Figure out what you need and that, do you want an IPO advisor or not? And I would say, talk to the bankers who you know and the lawyers who you know before you retain, as you think about IPO advisors. No, everybody has a vested interest maybe in keeping somebody in or out, but just get a perspective. I think one of the best things I heard about reference checking some IPO advisors, as I've thought about it both times, is I think one of the lawyers used a phrase that said, well, they're not destructive to the process. And that was, but the funny thing is that was the best compliment they could pay, because some of the other, there were some advisors who they're like, those people just create chaos, but those people stay on track and keep the banks on track. And how much do you want to manage of the bankers? How much do you want to be involved in syndicate construction, roles and responsibilities and economics? You can mix and match the pieces in just about any way, but it's a lot harder than you think. What company counsel lawyers do, what the auditors do. There's so many permutations of IPO advisors that I think it can get kind of confusing. Does that make sense, Mike?
Yeah, it does. Yeah, it does. And maybe just to double click on that, and John and Sherry, appreciate your perspective on it as well. I mean, as you go through the process, it's obviously pretty labor intensive as you craft a story and you're working on the disclosure part of it. And before you would have spent time in conference rooms for hours at a time. Now you spend maybe less time, but more frequently on Zoom calls. And I recognize it's a little tactical, but it can have a big impact on the management team's mood on a day-to-day basis.
Yeah.
How would you think about sort of managing the team as you're drafting and preparing your disclosure document? Because there's different models, and I'm curious if you guys have a view as to what you think the best one is.
So I've done it both ways, sort of traditional, in person and Zoom. If you're willing to be comfortable, if you're comfortable with probably a smaller group of banks and bankers being heavily involved, which frankly is kind of how it works out anyway, even if you started a traditional big group board meeting, you tend to end up with a relatively small number of your banks heavily involved. I found Zoom to be infinitely more efficient. Easier to schedule, kind of keeps everybody on track a little better, keeps this sort of posturing background noise. Drafting sessions are, an hour and a half, not 4 or 5 hours, and kind of chunk them off in, hey, we're doing business today. Now, my drafting sessions run on schedule, whether anybody likes it or not. But I think it's a little more constructive and easier for the management team, right? Much easier for CEO, CFO, head of FP&A to kind of go, okay, I can deal with this thing for an hour and a half, but man, it's 5 hours and, banker posturing and people talking over each other just gets to be kind of soul stealing in the in-person drafting session. I think the advantage of an in-person drafting session though is if you have a story that's less well understood and maybe you haven't spent a lot of time polishing it, or you haven't spent a lot of time with 1 or 2 of your bankers in the lead up to maybe your org meeting, then I think that I can see the value to an in-person drafting session if you really are doing the classic, we need to start with the whiteboard and do that. That I can see that would be lost in a Zoom drafting session, but I don't find that, 40 people in a room drafting session. I never thought it was terribly useful. I always thought it was astronomically expensive and just a waste of time. So now I'm like, oh, I'm doing this way. I don't know that I'll ever do an in-person drafting session again.
Yeah, I would agree with that. And I think it's something we all question going into this virtual world is what is it going to be like going through this process now remotely? And it's actually worked out very well. And I completely agree with you, John, that the drafting sessions can be shorter, can be more focused, easier to schedule. And I just think, more effective, and we're going to continue to see that, I think, as a way of operating. I don't think in-person is going to go away altogether, but this is a way to get a lot done in a more condensed, period of time. And I think the only other thing I would add to, how do you pick your advisors? One of the things that I think is important is just, as you're meeting with different people and interviewing and sort of assessing who you're going to work with, I think it's important to think about people who have a similar, personality style, or just people you think you're going to get along with, right? Because you're going to be working very hard, long days, and you just want it to be a good process. And so sometimes just that personal connection and synergy is important, and maybe not something you think about as you're looking for experience in industry and so forth. But I don't think it's something to be overlooked.
Yeah, and one last thing, we can move on. One constituent that we didn't talk about was counsel for the banks. This is actually one of the very rare times when you're at a company that you get to pick the other side's lawyers. And so, just following up on just riffing on something that Sherry just said in terms of personality, ask if you don't have a good sense of who else might be out there and serves those roles. Ask the other folks about who's good to work with, because that can make a big difference on how things go. Why don't we shift gears again to hit on a couple corporate governance points. Priya, maybe we'll start with you. What are some of the corporate governance issues that'll matter for going public when it comes to D&O insurance?
Yeah. So no surprise, the corporate governance things that are of interest to insurance carriers track nicely to what they think makes litigation less likely or makes it go away faster and for less money. I would start first and foremost with the concept of federal choice of forum provisions. So that's something that I know, Michael, you and your colleagues at Wilson Sonsini routinely put into your the charter documents of your new public companies, so that if you are sued on a registration statement, you're only sued in federal court. Actually, props to one of the partners at Wilson Sonsini who actually argued the case in Delaware, Shabakuki, that allows us all to take advantage of it. It's a really big deal. A related thing, which is a little bit older school, but I sometimes see people miss, is state choice of forum provisions. Another provision that goes in your charter document. This time it's about breach of fiduciary duty suits primarily. And you want to make sure that those are only happening if you're a Delaware corporation in Delaware and not 49 other states concurrently, and maybe some federal just to throw it in. So really important to control the litigation environment. I did mentioned just broadly from a corporate governance perspective already, recruiting very good directors with public company experience. I also want to mention the phenomenon of dual class shares. I have had 0 companies say to me, oh, I don't want to do those because it seems there's more litigation with those companies and it drives up your rates of insurance. And I get it. But we just should know that dual class and frankly, raising very large amounts of money does track to higher rates of litigation. I'm not saying it's causation, but there's some strong correlation. And one more time, it's just a risk that you're managing. I've had 0 companies say, you know what, we'll raise less. And the founder is totally cool with giving up control. It's just not how it works. The other thing I'll just mention, and Michael, you mentioned this earlier, is the importance of personal indemnification agreements. And that's the contract between the director and officer and the company that he or she is serving that talks about in a very personal way, hey, if you're sued or just some light investigative noise from the SEC, legal fees will be advanced very quickly, soft trigger. And it's especially important in the current environment because of what's happening with insurance pricing. And everything I've talked about does impact your insurance pricing. So just think of it this way. And John said this so nicely. In 2019, if you were trying to go public, on average, your deductible was $7.5 million, which is really high. That same company trying to go public in the first quarter of this year was on average paying about a $15 million self-insured retention. So it was already high and it doubled. And the cost of D&O insurance continues to escalate. So in 2019, first quarter on average, the first $10 million of insurance would cost you $1.2 million. That same first 10 million in the first quarter of 2021 on average had escalated more than doubled to about 2.5 million. A critical point here, though, is that better companies get differentiated pricing. You absolutely do see differentiated deductibles and differentiated terms and conditions. So the exercise of not just making sure you have these governance protocols in place, but also can talk about it well. I'm confident when John Murrow talks about the governance of his new public company, it's compelling, it's confident, and it's real. That makes a big difference in the outcome, because remember, your insurance carriers, they get no upside. It is a lot less about international galactic or intergalactic domination for them, and a lot more about visibility and forecasts and things like that. So keeping that in mind for governance makes a big difference for the D&O insurance.
Yeah. John, maybe you touch on some of the things that you thought of from a corporate governance perspective. I mean, I have thought about it. And I know there's differences between being at a venture-backed company or sponsor-backed company. I mean, so there can be, what are sort of the hierarchy of things that you've thought about when you've gone through it?
Yeah, so I mean, I guess the key question is Priya and you both said, right, is really dual class or not. I think if you have a founder-backed company in the founder-controlled company, founder-owned company, or a key insider-controlled company, I think you should think really, really hard about dual class, and somebody should really have to pry it out of your cold dead hands. I think because a year after you're public, 2 years after you're public, right? It's you're just another company with a 1, 2, 5, $10 billion market cap. And there are activists in the world that after your investors have distributed their shares, will take positions in your stock. And dual class allows you to think longer term. It doesn't allow you to be stupid. Like, you still have to make rational business decisions, but it means you're going to be a lot harder to bully in a given 1 month span because somebody didn't like something happen. So I end up feeling fairly strongly on that one. But lots of reasons why you also may not do it. Like, you may not have a founder with a big position. It may not make sense to you. And then I think there's a broader cascade of waterfalls in various dual class terms. I mean, there's some that are given, like 10-to-1 voting is virtually a given, but there's a lot of subtleties in those terms where it's worth spending time with your board and your lawyers and bankers to understand what's market and what will the market accept or not. But the market, if you're within the realm of reason, the market's sort of used to it. But there's thought process there. There's socialization with your board. There's Excel spreadsheets with what happens as various people sell down and distribute and things like that. So that'd be one. And then I think, more broadly in defensive measures, again, I think you're just trying to protect yourself so you can think long-term, not so you can be stupid. But personally, I lean towards go with the full slate of protective measures. And, you might get pressure on them later, and you can always unravel them. You can't go put them back in after you've been public for a year. And the market's pretty comfortable with that in technology companies. I think it's different in other spaces. But in technology companies, the market's pretty used to a fairly full slate of staggered board and, advanced notice provisions and things like that. There's kind of all run together as a blob. I'd take everything that was market and reasonable and take it. You can always unravel it later, but a year after you're public, you can't put it back in.
Yeah. Great. Thanks for that perspective. We want to make sure that we're leaving enough time to answer the questions that folks have. And so, but before we turn to the Q&A function, maybe if folks in the panel want to share a key takeaway or two before we shift to the questions. So Sherry, I'll start with you.
Yeah, thank you, Michael. So, and I think we've heard it here. I guess my words of wisdom would be, you can never plan too early. And the goal of planning is to create capacity in what you're going to need to deal with. You'll never anticipate everything, but maybe you'll anticipate and plan for, 80% of the journey. And that way, when the 20%, surprises occur, you can actually deal with them. So I think, that planning process should not be underestimated. It will serve you well along the journey.
Great. Priya?
So my comment is really about preparedness as well. And I would just ask everybody to ask themselves the question, do my team members seem drunk from time to time? They might be drunk, but it could be they're just unbelievably sleep deprived, which leads to terrible decision making. And I realize I'm the person doing insurance over here, but in my experience, the way a management team is handling insurance, including like discipline, who has the ability to make a decision, what's the process, that's not different than what they're doing for the whole rest of the business. So maybe sooner than later, think about, do my people sound drunk, or do we have enough support internally so that people are resting and thinking in a holistic way instead of just doing squirrel, whatever's right in front of them. I wish I were kidding. I've had a lot of meetings with people where I wondered about their life choices. So that's my advice.
Okay. Well, hopefully you're not going to question my life choices for being a law firm partner. But John, any thoughts you want to share?
I mean, I think maybe just one that comes up all the time, I think, is we didn't really touch on. I think the sort of SPAC, de-SPAC, direct listing, like all these are alternatives. I think it's and Mike, you and I've had this conversation. Like they are all options. Spend a bit of time with your lawyers, but frankly, the bankers will do free work for you. Outlining the alternatives and have a conversation. I think you have to commit to one of those paths more earlier than most people will tell you. I think it's just an illusion to say you're going to go all the way down an IPO path and you're going to switch over to a SPAC. Like, I mean, I know the exact crossover point where timing wise, like I could be done with an IPO faster. I could be done with a SPAC, and those kind of things. So I just like, that's one I think it's held out. It is an option. These are all legitimate and good choices, I think, in the market, and people should really think them through. But I wouldn't think you're going to run. You can't run all the plays until the very end, or if you do, you probably haven't made the best set of decisions. And like Priya said, you're probably seeming a little drunk in some of your meetings. Like I think you kind of got to. You don't have to pick one too early, but somewhere along the way, you got to pick one and declare. But also understand the pros and cons. As Sherry said, like, SPACs. I know SPACs that were in the hopper at the same time we were in for IPO. People I don't think were that well prepared on the finance and accounting side, from what I understand. Businesses that really accelerated. Several of those deals aren't done. Like they signed and announced a deal before they were done. I've done an IPO from org meeting to closure in much faster than some of those deals that are still winding their way through the S4 comment process, or that haven't filed their S4 yet. So I just understand some of those pros and cons, because it's all a great pitch, but it just, the mechanics of the way these deals work matter.
Yeah. Great, thanks for that, John. So let's go to the Q&A. The first question is, hopefully someone can explain that, why Amazon could go from formation to IPO in only 3 years. Maybe I'll take this one. Sort of mid 90s, if I'm remembering correctly, it was a very different time from a capital markets perspective. And I think there was a few things. There are significant costs to going public and being a public company. A lot of those things, which I think do inhibit some people making that decision, really weren't there at the time. Probably more importantly, since the time that Amazon went public, the private capital markets are much more robust, and so companies are really able to scale. Taking private capital at attractive valuations that it may not have been, the dynamics might have been a little bit different at the time. And at least my impression of the market, and Will maybe has a different perspective. There probably was a little more risk tolerance, at the time that went public. Now we're sort of in an environment where we had been with the SPAC market, which personally I think is a little bit going back to the dynamics from before. People were willing to take a little more risk for a company that wasn't as mature. And so, I think if you look at the companies that are going public that way now, as a whole, they're probably going from incorporation to being public in a shorter time frame than folks who would do it as a traditional IPO. The next question is, are there months where it's better to go public from on a traditional IPO? And maybe I'll rephrase that question a little bit. Are there periods during the year, Sherry, maybe this one can be for you, since I think it probably lands in your bailiwick a little bit. where it's difficult to go public? Are there periods during the calendar where, like, if you miss a window, you have to wait a little bit?
Yeah, absolutely. One of the timeframes that's probably the most challenging is when you start to get to the end of a calendar year. So most companies are going to try to get, their deal done before we get into the holiday period of Thanksgiving and Christmas and so forth, because finding a window between Thanksgiving and Christmas is very difficult. And then once you cross over, assuming you're a calendar year end company, once you cross over, your year end, there's a window maybe early in January where you could still go off of, 9/30, 9-month results. But the longer you go down, into the next year, the more there's going to be an expectation, maybe from your auditors of actually having audited, 12-month results. Some firms have a policy around that they won't, give an opinion on an IPO if it's after year end, but they haven't audited the full year yet. And just, that timeline then of closing the books and, getting through an audit. So that end of year timeframe is probably one of the more challenging. So, I see most companies trying to get it done sort of if they're towards the end of the year, early November. I think there are other windows, like summer tends to fall off a little bit, and it just sort of, the market tracks with, holidays and vacations and so forth too. So that tends to be something to take into account when you're looking at market windows.
Yeah, I agree. I mean, so late August, the period from Thanksgiving to the end of the year, not good times. Typically, although deals do get done, and then as you're sort of managing, results and sort of the market expectation to have visibility about how the last quarter or the last year went, that sort of time, to take that into account. John, maybe I'll give this one to you. Not that it's any particular situation, but as you're a seasoned general counsel, you think about these types of issues. For what advice would you give, management teams that they might have a board that's fairly heavily VC dominated? How do you think about transitioning that over time, or encouraging a transition potentially?
I think I think there's no right answer, and I think you can sort of trace through IPOs, and you don't. I'm not sure you can always see a pattern, but I think as starting that discussion at the board level, and probably the easiest place to start it, I think to Priya and Sherry's and your point, like I think the audit committee chair tends to be the one that starts the dialogue for a lot of people, because while in theory many VCs are actually meet the qualifications to be audit committee chair, I have yet to know one who wants to be, and some who can, because of some heightened independence standards, because of their ownership position, often could not, even if they wanted to. So I think audit committee chair tends to be a dialogue, and a lot of times, your independent seat when you're a VC tends to be a friend of someone's, and you may have to think about, do you add more independent seats, or do you replace your independent seat with a new audit committee chair? How do you feel from a diversity perspective? And is your board diverse, and how are you going to get there? So I think committee composition, audit committee tends to be the one that just drives a lot of the answer in my experience. But I've seen more and more of the late stage private companies. I think as ownership positions tend to get diluted a little further maybe than they did 5 or 10 years ago. I've been pretty impressed with the quality of boards that many of the late stage private companies have. So and I think that's because you don't have a single VC that owns 25%. You have a VC who owns 10% and a broader list of investors. So some of it's math. But I think you just got to have the dialogue. And I think, look, board members who've been through an IPO process, if you have one, they see the need for others. You have a VC who's been through an IPO process. I don't know. And I've had this conversation with a lot of people. I don't hear a lot of, oh, keep out of my way. I hear a lot more people going, no, let's start early, because you also want to make sure there's a fit and feel element there. So I think if you open the dialogue, it becomes a pretty natural transition.
Yeah, I agree with that, John. I mean, it's not a conversation I think people should be afraid to have, and have early, because for a lot of funds, they have policies that say, their investment professionals aren't actually allowed to sit on the boards of public companies. So that could be good or bad, I suppose. But if you're looking to transition your board, there's a group that's going to come off. There's other folks. I mean, and there's an economy of time for venture part, their job is to look for new opportunities, and as they exit their position in your company, they're probably going to be incentivized to spend more of their time on other portfolio companies, and there'll be a natural transition period. And finally, the professional people, and they understand the need to increase diversity on various different metrics as you become public. So I mean, I totally agree with you, John. Like have the conversation early, and don't be afraid about having it.
Yeah, because to your point, Mike, because even a lot of the firms are going to jump, like people are going to jump off. Like you don't want to be surprised. Like there are, particularly if somebody's a Series A or seed investor and they have a board seat through IPO, like they're almost always going to need to get off the board in that first year. Like, what you don't want to do is wake up 3 months into your IPO and 4 of your directors resign on you and you didn't expect it. Like you want to have a conversation to control that staging and phase.
Michael, I really want to emphasize something John said very subtly, but it's hyper important. This issue of independence. If somebody has a lot of social connections with other folks on the board or the CEO, they may not be independent in a way that you absolutely need them to be if you have some tough litigation. And so that is another reason to have this conversation sooner than later. The least effective, most expensive way to find a new director is after you have litigation and now you suddenly need independence. That sucks. So there's a lot of opportunity to make a board that can do a lot of great things for the company if you have that conversation sooner than later. And to the point you both made, a lot of venture capitalists have that expectation. They may be waiting for you to just bring it up so they can get on with it.
Yeah, and it's a great point, Priya. I mean, we often talk about independence in the context of the transaction. You're very focused on sort of the SEC and the exchange requirements, but thinking more holistically about really what independence means from a Delaware perspective, because there's lots of case law on that. It's not necessarily intuitive. So people that are investing together in multiple deals or have a social relationship, there are different kinds of independence that you should be sensitive to as you're constructing your board.
And I think it's just one example of how the more successful public companies are the ones that are thinking holistically, not just about the transaction, though, my goodness, that is a lot, but also public company life in the next 3, 5, 10, 15 years.
Great. I think we have time for just a few more, maybe. The next one, John, maybe I'll pitch this one to you first. The question is, how do you think about telling your employees about, whether you're pursuing an IPO? At what point in the process are you talking about it to your employees?
Yeah, I think so. Again, I think this one, the answer varies a lot, right? So it strikes me as completely, like, given my experience, it seems weird to me, but you can file a press release saying you filed confidentially if you want to. I think that's relatively uncommon, I think, on the data points that I've seen, although particularly some widely held, more consumer-driven brands have done that. Those at least are the ones that leap to mind. I think what fits for the culture of your company. Will people stay quiet about things and not run out and tweet things? Well, frankly, sometimes you need to tell them so they don't do stuff that's inappropriate. I lean towards probably keeping the team tight and small, knowing it kind of naturally leaks, and so it becomes a poorly kept secret within a company, but people know to keep it under their hat. That's my general lean, because I think the thing you have to remember is, a process, because the market can turn on you, a process can take a long time. Aptio, we filed, we went from org meeting to IPO to initial confidential filing in 30 days. Paymentus, org meeting to initial filing in 18 days. Market turned on us at Aptio, and this happened there were no growth tech IPOs for about 7-8 months in 2016. Add in the closing of the holiday window that Sherry factored in, you had like 8, 9, almost 10 months where there were basically no IPOs. And if you told your people, like formally in a big kickoff meeting a year ago, wow, they may think there's something broken, and they may talk to partners about it. So I think you got to do what's right for your culture and your company, but I probably lean towards telling people later, because you think it's going to go fast, but you don't control the market. But there's not a right answer to that. If you do it, coordinate carefully with, if you tell people early, you got to coordinate carefully with your lawyers and the bankers and people to make sure that you don't create unintended issues, because there's a lot of unintended issues that
Yeah, I agree 100% with what John said, and I think it totally depends on the culture of your company. I'm aware of some companies that it was super double secret. You didn't talk about it in the offices. You actually rented a separate facility where you would take everybody to do your drafting sessions and meeting. I mean, you could take it to a real extreme. And there's other companies that, because they share information all the time, they tell folks, and there's folks that come in sort of in between. What I guess I would probably advise people not to do is say you're going to keep it secret, and then bring an army of lawyers and bankers trace people through your offices. Like when we go back to the offices, that's the classic thing. And people do talk, so you have to sort of strike a right balance between keeping it close and managing expectations, while at the same time giving people the tools to do the right thing.
Yeah, and to that point, I think there's probably a universe of people you might need to tell, even if you go to the more conservative end, because otherwise people are going to freak out and think you're selling the business when you're not. And so, even most conservatively run, you start to talk to the accounting and finance people and some key people in product who are giving you data, because otherwise people think you put the business up for sale when you didn't. And so there's it's not 10 people who can run an IPO. It's probably a choice between, I don't know, 30 or 50 and, the entire company knowing. You can't keep it with 5 people, to the end, even as much as I would like to, because literally everyone will think you're selling the business and they will freak out.
So we're at the end of the hour. Apologies for the folks for whom we didn't get to your questions. I'd be happy to follow up with anybody who wants to talk about that after the meeting. But you really appreciate the panel and all the audience this time, and the center for putting this on.
Well, my goodness, I feel like all of us are thanking you and should be thanking you for the great insights, and learning how to strike that right balance. Definitely something that we aspire to every day here at the center. So just thank you to everyone joining us today. As a reminder, we are going to take that very quick 10-minute break, let everyone get a good stretch, hopefully a refill on coffee or whatever your beverage of choice is without that getting drunk moment. And then we will come back. We're looking at executing our IPOs. So thanks so much, and we'll see you all very soon. And for those of you just joining us, welcome. For those of you returning, welcome back. We have a great panel ahead, and we're excited to get going with that. But before we do, just a couple of really quick housekeeping reminders and/or cues for the first time. For the best user experience, we do suggest that you go ahead right now and click into Gallery View on your screen. And as a reminder, we're going to be opening up for live Q&A at the end of this session. So please submit your questions into that Q&A function that you'll see at the bottom of the screen throughout the discussion and whenever you have questions as we go. Now, as you settle in, we also just wanted to get a really quick temperature check on how and who we have joining us today. So I'm going to launch a very quick poll just to get an understanding of whether or not in the next 6 to 12 months you're planning on an IPO. If I could invite everyone to please just fill this out for us really quick. This will help our panel today really orient their questions, their discussion points around making sure that we have as much useful information as possible for all of you. So thank you for those taking this poll. I'm going to leave it up just for a little bit longer to get as many participants as possible. Good to see that we're about blended right now. I've headed in that direction, not quite yet, and yes, but not certain on that timeline. So a fairly blended environment right now, although anchoring maybe a little bit more towards heading in that direction. So let me go ahead and end this poll really quickly and share those results with you. And while I do that, let's get started with introducing the panel. So without any more delay, excited to develop Executing Your IPO. Please join me in giving a very warm welcome to our guest today. We have our moderator, Jack, Vice President at Nasdaq. We have Pat, CFO at Too Simple, and Robert, CFO of Big Commerce. Team, over to you, and thanks so much for your time today.
Thank you so much, Nicola. And just doing a quick audio check. Robert and Pat, can you hear me?
I can.
Okay. No audio. Okay. Robert, we're looking into that real quick as I'm doing, I'll kick off with a few opening remarks here, but I just want to say good morning again to everyone and thank you for joining us on this second panel of today's 2021 Summer IPO Bootcamp. As you know,
Jack will be right with us in just a moment,
audio.
so hang on just a second. Perfect, Jack, you sound great. Thank you.
We good on audio there? Good.
Got it.
Copy. We're rocking and rolling. Well, I was just going to say, usually we're doing these in person, and I think I probably speak for the vast majority of these that we cannot wait to get back to person and get off these Zooms. But for sake of where we are in this part of the cycle, we're doing another virtual event. And again, so thrilled to have our two guests today, Pat Dillon and Robert Alvarez, two incredible CFOs and leaders that led their companies through successful IPOs. And we're going to hear from them today about scaling a business, kind of the preparation that goes into that, up to executing the IPO. And then, they're both now seasoned vets with a quarter or a few under their belt. And so now we'll get a few questions around kind of scaling the business. So without further ado, I'll go ahead and just jump right in and ask both of you to give the audience a brief introduction on yourself, your role, and maybe a little bit about your career. We have a lot of young aspiring leaders tuning in today, so I'm sure they'd love to hear a little bit about your path and how you got to the seat where you are today. So Robert, I'm going to start with you.
Sure. Hey, Jack, hey, everyone. So Big Commerce is a platform that helps merchants really of all sizes sell products online. We focus on merchants, retailers that sell products. We serve small, medium, and large merchants, both B2C and B2B. And we try to make it super easy for them to get online. We try to drive a lot of orders to their sites. We're a SaaS platform, but we feel like we're the most open SaaS platform in e-commerce, meaning you can customize this. We're very flexible, and we provide kind of what we think are best of breed options across e-commerce. Big Commerce is actually my fifth venture-backed startup, all in Austin. First one went public in the late 90s. The next three were sold to strategic acquirers. And BigCommerce is, I started here in October of 2011. I was employee number 44 at BigCommerce. We just closed our Series A round with General Catalyst. Our founders were based in Sydney, Australia. They needed someone in the U.S. to kind of look after things in the U.S. And it's been one crazy journey, a lot of ups and downs. I remember going public, and it was like a 10-year overnight success. It was a lot of reflection of the journey to get there. But one thing that's always been special about this company is what we do resonated with me on a very personal level. I remember before BigCommerce, my lens in startups were, how big is the market? How disruptive is the product? Can I help build a team and culture to, allow the company to reach its potential? But the fourth one, I actually learned at Big C, and does it resonate with you on a personal level? I'm an immigrant from the Philippines. My dad had a very successful textile business in the Philippines. We immigrated to the US, typical immigrant story that my parents wanted a better life for us as kids. And I remember helping my dad try to sell his goods. He converted our garage in Houston into a factory. He would make snakeskin belts and snakeskin boots. And I remember being 9 years old, going to the flea market in Houston, trying to help him sell his products. And, if 10 or 15 people came to the booth, we'd be so excited. And my first month at BigCommerce, I just saw all these merchants that we were helping and all the success that they were seeing online. And I just couldn't help think about my dad. And I thought to myself, man, if this was around when I was a kid, what impact would this have made for my dad? What impact would this have made for my family? And, I still feel that way. It's a big reason why 10 years later, I'm still here.
Oh, well said, Robert. That is a great story. And again, we can always see the passion. I think that's always something that resonated with me and us as we work through the process together as well. And it's great to hear the full story. And Pat, turn it over to you. I know it was maybe a shorter tenure in joining Too Simple, but a little bit about your road to Too Simple and the path there.
Great. Yeah, thanks, Jack, and great to be with everyone. So Pat Dillon, I'm the CFO of Too Simple. Too Simple is an autonomous trucking technology company. We are the first publicly listed autonomous vehicle company in the world. It is, at the heart of it, an artificial intelligence company founded in 2015 in San Diego. And we are focused on revolutionizing the $4 trillion global truck freight market. Everything that's in your home or office most likely came on a truck. And we believe that autonomous operation for certain routes is going to make trucking safer, more environmentally friendly, and much more efficient. So that's what we're focused on. Before joining the company, had spent 10 years as an investment banker at Morgan Stanley. I had spent most of my time focused on companies that were revolutionizing the mobility space. So whether that be alternative propulsion technologies, telematics, or autonomous operation, I spent a significant amount of time helping raise capital or participate in mergers and acquisitions around these types of topics. I started working with Too Simple as their advisor in 2019 and helped them raise a Series E capital raise over the course of 2020. Actually, I think, COVID essentially put a Series E capital raise, which we were about to launch in March of 2020, on hold for about 3 or 4 months. And while obviously that was disappointing and it was a huge global health crisis, it did allow the opportunity for me as an advisor to spend a lot of time with the CEO and the founders to think about the strategy and the vision on how to market, which is sort of rare as you think about these, and built a very deep bond and got very convicted about the company, the technology, and the opportunity. And so when I had the opportunity in the fall of 2020 to join the company as the CFO, it was a super exciting opportunity, and one that I felt like was a once in a career opportunity to join a company in this type of role that you could have an impact in a company that was going after such a big opportunity. So I've been here. We went public just in April. We're enjoying life as a public company and growing and scaling and trying to grow up as a company. We've certainly had plenty of growing pains, and I'll be happy to share some of those with the panel. But it's been a wild ride, and I'm thrilled to be here.
So I'm actually going to throw it back to you, and kind of the first question for both of you, but Pat, I'm going to start with you, is just starting with the theme of timing and preparedness. And what we're seeing right now, and this was touched upon in the capital markets update earlier, but there's been almost 500 IPOs this year in 2020 alone. There were about 450 last year in the total year, which was unprecedented. So there's a lot of companies coming to market, even excluding some of the SPAC craze, if you will. So it does seem that companies are trying to execute their IPO as quickly as possible. So as you went through this process with Too Simple, as you kind of mentioned around the Series E and a bit of a pivot there, but also when you put your banker hat on and working with companies, I guess what are a few things that can be done to ensure preparedness? And maybe a follow-up to that is, working with other service providers. When's the right time to engage?
Yeah. So I think for us, using the Series E in some respects as a dry run for the IPO, to refine the story, to talk to a lot of the same types of capital providers that are investors in the IPO was very helpful, to understand what they were concerned about. And certainly investor feedback doesn't dictate your strategy, but these are smart people that have seen companies like ours develop and taking their input to heart as you think about what is the message in the story was certainly helpful. As a practical matter, we really started preparing for the IPO about 9 months before we actually IPO'd, 9 to 10 months. So it is a long process. I think if we would go back and do it again, we'd probably start even a little bit earlier. We had to go do a full kind of PCAOB audit, which obviously is something that was time intensive, despite the fact that our operations were fairly limited, at least from a revenue generation perspective. There wasn't a lot of complexity to our accounting, but it's still a significant lift for an organization, particularly if the accounting team is really set up to be a private company. And not having all of the bodies and resources on board that you need to be able to do the full PCAOB audit and be ready for regular quarterly reporting. So that's one where we had to scramble a bit, and we were lucky enough to bring on a lot of really talented people to help us with it, but certainly took a lot of time, and engaging with your auditors around that early is helpful. In terms of bankers, we started back in August of 2020 to write the S1. And so spending a lot of time refining the S1 was, I think, critical for us. Not a document that you want to rush, because even though there are other marketing materials, including a roadshow presentation, which you're going to use to really talk to the story when the rubber meets the road in talking to investors, everything in the next batch of marketing documents needs to be consistent with the S1. So thinking hard about your story. What are your KPIs? What are the specific metrics that you want to highlight, and the elements of your story that you want to put out there are really important. And it's worth taking the extra time, as painful as it can be, doing iteration on iteration. That's really an important thing to spend time on. We thought it was very helpful to have the banks involved early, to have people who can be extra bodies to help with drafting, thinking about how to tell your story graphically, because while it is a narrative document with the S1, using graphics liberally, I think, is helpful, and different types of charts to help bring the story to life. And then also having, of course, your counsels engage, your counsel, underwriters counsel, getting that experience around to make the process with the SEC as smooth as possible. Last point about outside service providers. We did use an IR firm as we got closer to the actual IPO execution. We brought them on around Christmas time, leading up to the April IPO. And they were very helpful for us to think about things like managing the analyst population, which is a little bit tricky due to some of the rules around the Chinese wall between the banking side of an investment bank and the research side of a bank. And we found it very helpful to have, we used Blue Shirt Group, and they were very helpful, but there are a number of very high quality IR firms that can help you with that process with the analysts. and just a lot of making the logistics run smoothly, in addition to being sort of a second set of eyes to help you refine your story, and coming in slightly later time period than the banks.
Yeah, that's great. And so, Robert, throwing it over to you then, similar, same question, I guess, just walk us through that timing and prep from the BC side.
No, I think those are great insights from Pat. I'll just add just a couple stories. So I got hired in October of 2011. In November 2011, my first month at Big C, I remember doing a blog post for our employees, and I ended my blog, I said, how excited I was, why I was so excited, but I ended the blog post. Remember, I was employee 44. I think recurring SaaS revenue at the time was $7 million. And I ended my blog post saying, I cannot wait to take this company public under the ticker symbol Big C on the Nasdaq. This is my month one at Big Commerce. And so IPO for me and for our investors, we were all aligned that we do believe that that was a viable option for us. The thresholds of when you could go public changed. I remember back then you just had 50 million in recurring revenue, you could go public. Then that went up to 100 million. And so I stopped talking about IPO, but it was always kind of, hey, that's what we're going to go do. And I remember putting a plan, a readiness plan, and a recommendation to my board. This was in June, July 19. Similar to Pat, it was like a 9-month readiness plan. We were targeting March 2020. And I remember the month before putting that plan in front of the board, I had a drink with one of my board members. And I said, hey man, I'm put this recommendation together, and man, this readiness plan, like, I don't know if we're going to be ready in time. And he said, all right, let me tell you something. Half of my portfolio companies are public. I can tell you, you're more ready to go public than the majority of my companies that are already public. Like, anyone in your shoes at this stage doesn't think that they're ready or can be ready or will be ready. He goes, put the plan in place, you'll execute the plan, and you'll be ready. And I'll say, okay. And it was really true. I mean, that plan allowed us to identify the things that we really needed to fix quickly. Similar to Pat, we wrote our S1 pretty early. One of the benefits of writing the S1 was we really had to think through what metrics that we wanted to share. I mean, once you share the metrics, you got to share it every quarter. And what we found was like, gosh, our internal reporting, our data, we spent a lot of time cleaning it up, single source of truth, but it was on a store basis. But if you think about our model, one account can have a lot of stores. Procter & Gamble, for example, we power 95% of their direct-to-consumer sites. One account has 80 plus stores. Our whole database was store-based, wasn't account-based. So in 2.5 months, we had to completely change our data warehouse to be account-based, not store-based, so that we can provide the key metrics that we felt really depict the land and expand model of the business, expansion revenue opportunities. But having done the S1 early enough, we had time to do that. One of the things that we also did is provide kind of monthly updates on the readiness plan, which I thought worked really well. We were on file confidentially 2 weeks away from the S1 flipping to public, and COVID hit. And Jack, you know better than anyone, March of 2020, our investors, our advisors, everyone we were surrounded with said the IPO window is closed for 2 years. That's what everybody was telling us, like minimum a year, maybe 2 years. No one's gonna go public for 2 years. And we're going, oh my God, we're 2 weeks away from flipping our S1 public. I mean, we were ready to go. We were ready. And so we hit the pause and we're like, okay, well, I guess we're gonna have to wait. And then, you know, we're basically going down the field to the 1 yard line. COVID hits. We have strategic interest as well because we were running a parallel process. No IPOs for 2 years. All right, let's evaluate this strategic option. Go down the other side of the field to the 1 yard line. What we realized was every week that passed by, our business was doing fantastic. E-commerce was growing like crazy. Merchants were doing great on the platform, and we were like, okay, well, no, this every week that passed by, the IPO started to become the clearer option. And as soon as we could go out, I think we tried to go out, but we ended up going out in August. We were ready in March. We had to explore the strategic option. So once we said no, IPO is the way to go, we went from that side of the field back to the other side of the field and finally got the IPO across the line. But yeah, 2020 is a year I'll never forget. And the team did just a fantastic job kind of rolling with the punches and exploring all those options. And to finally go out was just, was awesome.
Yeah, that's, well, I remember obviously the conversations we had throughout the process, kind of post, not knowing how close you were necessarily in March, but just the momentum you had. And I think to you and Pat, obviously for Too Simple surviving and all in the audience, it's been incredible to see the balance through our ecosystem of companies that have been able to kind of fight that storm and then come out on the other side bigger and better and stronger for it, right? I think a lot of management teams had to look inward with the board, with their executives, with even that tier 2 leadership saying, hey, how are we coming together to continue to execute through this? I mean, we all got that memo at some point in March where, hey, the offices are closed, pack your stuff up and, we'll let you know. I think slowly but surely we're all kind of getting back into the office. I know, unfortunately, Austin's a bit quicker than us out here in California, but it has been incredible just to watch all of these companies move through. And I think both of these are great success stories, but specifically, all right, that pivot at that time was incredible.
Yeah, one thing I didn't mention in the readiness plan, it's usually like systems, process, and people. And that's the time you kind of have to look at yourself in the mirror and say, what does it need to be versus where it is today? Just one piece of advice is I think setting a goal line was just a great forcing function for me, for the team, for everyone involved. Like it was just a great kind of catalyst and forcing function to just get it done without having that recommendation or plan in place or having kind of a readiness view. It's kind of hard to do that. So that's definitely a piece of advice I give. One other piece of advice I give that a board member gave me is every investor that you meet with, rank them. So, you and your CEO, you're going to meet with investors, you're going to have NDRs, you're going to have testing the waters meetings. The day before your IPO, you're going to price, your deal, you're going to determine who gets shares. Every meeting we had with an investor, and some investors, they had 5 or 6 scores. We would score them on conviction on our story. Were they jerks or not? Do we like them? Were they kind of culture fits? And do we really think that they would be long-term investors? And we would score them A+, A minus, B+, B, B minus. And that day before the IPO, that scorecard was right in front of me, right in front of my CEO, and that's who we allocated shares to. I mean, no matter where the orders were coming in, we gave the shares to the A+, the A's, the A minuses, and I think it worked really well. I mean, we opened, we priced at 24. We didn't open until 12:30 in the afternoon because nobody was selling their shares. I mean, it was $60, $62, $64, $66. I mean, we priced at 24. No one's selling at 66. So they finally opened the stock at 68. I don't think that dynamic would have happened if we didn't give shares to those folks that we scored so high. So I would definitely pass on that advice.
No, that's great. And I do want to come back to some of that investor and analyst engagement as we kind of working through that timeline to the process. But that's a great point and case study there. I guess, Pat, turn it over to you just kind of as we're thinking about building out that management team in your lieutenants, if you will. I guess, what are really the top 1 or 2 considerations for evaluating or building out your management team prior to going public? CFO. Pat, I've got you on mute, or I can't hear.
Sorry. Oh, sorry about that. Can you hear me now? Yeah.
Got
So
you.
I think Robert alluded to this too, that you have to have just a very realistic, clear-eyed view of what your team has and where the holes are. And so, for Too Simple, we added some significant expertise. We hired the person who was the regulator for our entire industry, for the entire trucking industry, is our chief legal and administrative officer, because regulation is so important when you think about hauling freight, and especially trying to change the paradigm and haul freight autonomously. So that was a super significant hire for us. And we also made others that were less visible to the investing public, but no less important around getting to the IPO. So people on the accounting team, people on kind of from an equity administration perspective, from a legal team perspective. So we did have some significant kind of additions to the team to make sure that we were ready to go to the IPO, both in terms of the leadership team that the investors were really getting behind, as well as just from a practical perspective, making sure that you were actually ready to execute the IPO. So I think it's hard when you go from a company that's sort of living quarter to quarter and trying to be very judicious about their burn rate, especially we have a very modest amount of revenue. And so investing in expensive people that are, really necessary to be public, but you could probably get by without them as a private company. It's really that conviction that we are going for the IPO, and you're just going to have to make that investment. It's a necessary piece of being able to scale and live life as a public company.
Robert, same question. As you started the process a bit earlier, what were some of the key hires for you, or as you look at it?
As I reflect back, operations reports under me. So my COO reports to me. Having a centralized ops function where we really spent the time to understand input metrics versus output metrics, and really kind of instrument and measure kind of end-to-end flows to where we could predict the business better. That was critical. I mean, the one piece of advice I give you is if you don't have that operational cadence or ability to really forecast your business in a way that's very predictable, you got to figure that out. And that's how we figured it out. We have a really strong ops team that was great. Other internal team, executive team was pretty public company ready. We had a good mix of executives that had great IPO experience. For my team, we had to ramp up our accounting teams. I brought in a principal accounting officer. He was a former CFO of a public company. That was a critical hire I made right before the IPO. We beefed up our FP&A team for sure, beefed up our data team. If I think about SOX and compliance, we had to add in resources for that. But, to Pat's point, I think you got to kind of skate to where the puck is headed when you think about how you're going to build out the team. At that point in time, you really got to think through bringing in folks that have had those scars, have been kind of wise going through those processes a couple times. That really helped. And then on the external team, I had been meeting with bankers for years before we ultimately decided to go out. So by the time, we were trying to put our syndicate together, I kind of knew who they were going to be. And I also kind of knew what they were good at. So we built our syndicate out based on the strengths of each bank and what they could bring to the table. And that was super helpful because we leaned on one bank for kind of benchmarking and metrics and KPIs. We leaned on another bank for their ECM desk, and trying to figure out that syndicate, understanding those relationships was super helpful. And then, like Pat, we brought on ICR as our IR firm, and I actually did that pretty early in the process, and they were helpful in putting the syndicate together, all the analyst days, the teach-ins, giving me some great insights in G2 on the analysts themselves. They're super important post-IPO. So that definitely served us well. Figuring out your internal team, but also your your external team.
And then question for you around just kind of the communication. Obviously, you both have great relationships with your respective executive teams and specifically your CFO or CEOs. But how did you communicate and kind of coordinate with the board members? I'll start with you on that.
Sure. So for us, it's pretty like almost day to day, or at least on a weekly basis, communication with our board as we prepared for the IPO. And they all wanted to be, very involved with it. And in fact, two of our outside independent directors who both have significant public company experience, were sort of instrumental in helping guide us through the IPO process because they had been through it a couple of times. So Brad Buss, who was the first outside director of Tesla prior to their IPO, came onto our board around the same time, kind of in middle to fall of 2020. And so, we obviously love to draw comparisons to Tesla and say that our market cap is going to be, whatever, $600 billion someday. Having somebody who was actually there for 10 years with Elon Musk and helping to build that organization was super helpful for us. And some of the parallels between not just the Tesla story, but other companies that Brad had been a part of in the tech space over time was helpful. And we actually had, in certain circumstances with our testing the waters meetings, Brad actually joined, not to present, but sort of to say hello and kind of give a little bit of it's always nice when, Brad can join a meeting with like a BlackRock or a Fidelity and say, these guys remind me so much of, Tesla, or there's so many elements of the story. And it's the same PM that has been, had a very successful run as an investor in some of his prior companies. So, I think every situation is different, but I would say involving your board heavily, so they're quite aware of it, and thinking about what they can actually do. Most of our board members wanted to be involved. How can they help? How can they, actually add to some of the relationships with some of the PMs? So it's not just, the same person from an ECM desk at JP Morgan or Morgan Stanley calling. You have a little bit more of a personal connection, and the board member can tell you this person why they're so excited.
Yeah, I mean, similar perspective from Big Commerce. Our board, thankfully, number one, they've been aligned with us the entire time. They're very long-term minded. Thankfully, they're also ex-operators. So a lot of our board members used to run companies themselves. So they were very empathetic to what we were going through. But in terms of cadence, we kind of give monthly updates to the readiness plan. I mentioned earlier, we kind of had to go down this side of the field and to this side of the field. So I actually had to kind of give them weekly updates on the business, given that dynamic. But when it came time to decide, we're going to go public, they were involved every step of the way. No surprises. Give them updates. I'd say really around the readiness plan and how the business was performing on a weekly basis.
That's great. That's very helpful context. Maybe switching gears a bit, and Robert, you had touched upon this briefly, just on selecting the banks and the process you had gone through. That's such a critical element to the IPO process, one that CFOs typically get tasked with, right, in different influence, and a lot of these are longstanding relationships if the bankers are doing their job. But maybe walk us through a bit more detail around just your selection criteria. You discussed kind of why you hired them, but maybe just double clicking on that a bit more for those CFOs that are starting to have those relationships, or maybe even starting to present at conferences and kind of the momentum that garners.
Yeah, I mean, our lead was Morgan Stanley. Second slot was Barclays. Both banks had invested a good amount of time with us as a private company. Morgan Stanley in particular, Brett, it's probably 4 or 5 years I was working with him before our IPO. And He leaned in heavily in terms of biz dev introductions, corp dev activities. He did a lot of free work for us. Like, he put in the time, put in the effort, and he wasn't coming into this thing right before we were going public. And so that meant a lot to us. We wanted to reward that. We wanted to reward him leaning in and investing so much time and effort trying to help us. Jeffries was also a book runner for us, really strong ECM desk. KeyBank was a book runner, and they're just really strong in benchmarking and KPI. So we leaned on them very heavily. And then in terms of the co-managers, ICR gave me some great insights and feedback on the analyst. In hindsight, I wish I would have spent more time with the analysts earlier than I did. I think for most of them, I had a good relationship. But I don't think it's ever too early to really get in front of analysts, tell your story, let them really understand the differentiation of your business. But yeah, the banking relationships went back years, Jack. I mean, it was a long time.
Yeah. Okay. No, that makes sense. And I guess maybe switching gears, Pat, it was a bit of a different relationship for you because you were actually covering Too Simple a bit. So you're doing all the great things Robert was saying. There must be something in the water there.
Pat really leaned in so much. I mean, that's even better.
Yeah, exactly.
Yeah.
That's how you really lean in. Morgan Stanley was kind enough to give an employee as the CFO, so that helped them become lead left. But yeah, it's I mean, I think the points Robert made are great. I think getting to know the analysts all the way down through not just the 3 or 4 big analysts in the space, but trying to develop a relationship with 10 plus analysts is hard to do, but it's time well spent. If you can do that, a year or 2 years before the IPO, most of the time they are very happy to learn about kind of emerging companies within a space, especially if you have a differentiated technology aspect. So we leaned on Blue Shirt to help us round out the syndicate, particularly at the co-manager level. They gave very good insights as to who they thought would be good research analysts on the co-manager level. On the kind of the leads, we started with 2. We added a 3rd kind of active underwriter. Kind of later on in the process, we added JP Morgan. I thought that was actually a helpful dynamic. I mean, every situation is different, but it's always good to kind of keep people on their toes a little bit and have a new kind of fresh set of eyes to the party and make sure that everybody is kind of pulling their weight and working really hard, and competitive tension is always good with banks. So we were really happy with the way it all played out. For us, I think the one thing too is to be vocal about how you want to be covered from an equity research perspective. So for us, sitting kind of in between freight transportation, automotive technology, general tech, software, artificial intelligence, we wanted a mix of coverage. And we kind of identified which analysts, and for the larger banks, we wanted co-analysts. So for Morgan Stanley, we wanted Ravi Shankar, who covers freight and freight technology, but also Adam Jonas, who's kind of, well-known auto tech analyst. And we wanted both of them to be on the reports. And the same thing kind of went for all of our different, main banks that could have both a freight analyst and a tech analyst. And we thought it was important. You have to understand the end market, but you also have to understand, a tech company that could be valued at, multi-billion-dollar market cap, even though the revenue story is all ahead of us. So I think really think hard about who you want to cover you and make sure that you have the right mix of people who are going to understand not just your end market, but the valuation paradigm, especially if you're a sort of a new disruptive technology company entering a space, and really think hard about how you customize that.
Yeah, that's great advice, Pat. I'm really glad you brought that up. That's very insightful and really great advice.
Yeah, I agree. Now, I guess, Pat, maybe to you and for both of you, but Pat, I'll throw it back to you. Do you recommend a kind of a minimum number of meetings
with kind of the analyst investors, or how did you force rank some of them? You came in with and also leveraging Blue Shirt or ICR for Big C, but how did you force rank some of the investors as well as the analysts that you would spend more time with to get that story right?
Yeah, I mean, I think from an analyst perspective, you can use both so we did sort of informal surveys of investors who we thought were important in the space, on who they thought were the best equity research analysts. And you can obviously look at, institutional investor rankings, and you can kind of read their reports. It's real easy to actually develop a relationship. They all put their email addresses on the cover of the report. Just email and say, hey, we're a new company. We'd love to kind of get to know you, tell you a little bit about our story. And you can get put on their distribution list, start reading their research. You can get a good sense of it. You kind of triangulate around who is going to be both impactful and who's the type of person who's going to be, very constructive around your particular story, and who you think will. The equity research analysts are very important because they do tell your story in many respects. So you can't 100% control an equity research analyst. They write independent research, but you can be impactful in selecting the types of people that you think will understand the story and won't get it wrong, I guess. Even though they'll be balanced for the most part around the pros and cons of your story, you do have this impact on who you want to be telling the story. So we spent a lot of time with them, and I think it's pretty simple, pretty straightforward. For us, prior to COVID, the best thing we could do is we would email an equity research analyst and say, hey, would you like to take a ride in our autonomous truck and see what it's like? And that was the single best thing we could do, because for us, the experience of riding in a truck and seeing that, yes, there's a safety driver behind the wheel, but this truck just drove on surface streets and highways, and it did it without a single disengagement. It makes the whole story real. So think about what's the best way to interact. Certainly during COVID, we did regular meetings over Zoom, and not everybody can do it. But if there's an experiential aspect of your story, think about what's the best way, because that is a way to grab an equity research analyst's attention and get him or her really excited about your story. And if they're excited about your story before the IPO, that's great. You want to kind of bring them on board as a true believer in your company before you go through the formal process of the IPO.
Yeah, one of the things that we teed up for our analysts were kind of demos. So I brought in our solution architect that would actually show them a demo that we would give to a enterprise merchant. Like you, Pat, our version of Tesla is Shopify, right? So those analysts that I love, the analysts that had experience before Shopify, like knew the legacy systems, knew the Demandwares, knew the Magentos, knew the Oracle, ATG, IBM, all the legacy systems, and their understanding of their limitations, because that's essentially who we were really going up against. And so showing them the demo, like actually putting them in the shoes of a prospect, they're like, okay, I got it, I understand. Like, completely different platform, makes a ton of sense. I know who you're going after, and it out of the gate, they kind of got that experience. So highly recommend doing that demo experience. And I wish I could put them in a cool car like you. I couldn't do that, but I could show them a cool demo.
Yeah.
I want one of
those,
by the way. They look great.
Yeah. I know, they're slick. So then kind of walking through the timeline, pulling us up to, call it the road show, right? Mm-hmm. So we'll start our big commerce. As much as you were ready in March, the world gets flipped upside down. You're doing the dual track, coming back to accessing the public markets in August 2020. So again, pretty shut down as it relates to in-person meetings, travel, etc. Walk us through what it was like doing that road show virtually, kind of just the cadence and the bandwidth that you and the team had or didn't have, I guess, leading up to IPO day, pricing, and then subsequent IPO day.
Yeah, I mean, we didn't know what to expect, really. You know, we were one of the first companies to go public once the window kind of opened again. But man, I got to tell you, it was super efficient. I think we did our whole roadshow in 3.5 days, 4 days max. Never had to get on a plane. My CEO and I got to sleep in our own bed at night. I mean, we were back to back to back. One thing we did that was advisable is make sure you actually block a time to eat lunch. Otherwise, you'd have back-to-backs and just wouldn't even eat. But yeah, we got it done in less than 4 days. What was super helpful was kind of that book building, getting that scorecard, understanding, you know, you get 3 hours to determine who's going to get your shares, right? And you're going to be oversubscribed, and you're not going to know if you don't have that reference point. It's really hard to determine who you really want to allocate shares to. But yeah, I think the investors we spoke with, and I think, you know, there's been so many IPOs since that I know it's a strong preference from the management teams. The virtual roadshows, it's so efficient. You don't have to waste time going from meeting to meeting. You know, you wrap up one, you jump onto the next one. And I think the investors preferred it as well. I mean, Pat, I don't know if you had the similar experience.
Yeah.
But.
Yeah, I don't think roadshows are ever going back to in person. It is very efficient. You can get to different parts of the world. We were doing U.S. meetings, you know, during the U.S. and Europe meetings during the day, Asia meetings at night. It's having participated as a banker in a lot of kind of these grueling roadshows where you're going, you know, one meeting to another in Midtown Manhattan and catching a flight to go to Baltimore or to go to the West Coast. It's definitely better, much more efficient to be able to do it virtually, and can't see a world where it goes back to in-person roadshows.
Yeah, we had the benefit of meeting a lot of investors in person already, you know, a year or so before the IPO. So by the time we did our testing the water meetings and the actual roadshow, a lot of them we had met in person, which was nice. But man, in terms of a process, it was super efficient. Super.
Yeah, I think like all things, you want to think about where is an in-person meeting impactful. So things that are experiential, think about ways to do that and potentially do that ahead of the IPO, where you can, you know, for us, it's getting people to take a ride in our truck. And that's the most impactful thing. And we had many investors come down, even during COVID and in sort of the fall of 2020 or early winter of 2021. You know, we had we had one investor who took a 7-hour drive from Los Angeles to come and take a ride in the truck. He wasn't comfortable flying yet, but he was willing to drive. So that was great. And we made sure to give him a nice allocation. And he's been a great backer of ours since that point in time, and people who chartered planes to come down. So think about different ways where you can have an impactful in-person, because I think you can really maximize the value of that in-person. And then it's old hat when you kind of get onto a Zoom call, it's somebody you know already, and you have that rapport already built, because and then you just can kind of, be really efficient on the roadshow and touch a lot of people. And over, a period of 6 days of marketing, you can really get the message out to a lot of folks.
Well said. Well said. And that's what we're continuing to hear through this next class of companies, and even those kicking off their roadshow now, targeting kind of this late June window, just how efficient it is. I think as the markets continue to open up, we're seeing more people travel back to New York for some bell ceremonies, which we got to celebrate with Pat and Robert. We can't wait to have you guys back for an anniversary here. But with that, I'm going to answer a call on a few questions from the audience here, just for us all. So one is, during the first panel, they shared a lot around directors and officers insurance for IPO companies, and there seems to be a correlated rising cost with this insurance. I guess, Robert, starting with you, is there a reasonable budget for this insurance, and how did you factor that into your timeline?
I'll tell you, my biggest sticker shock through the whole IPO process was the cost of D&O insurance. I mean, it was, everyone feels that pain. And we were, I think we had budget $4 million for D&O coverage based on an estimated market cap at IPO. And if that market cap increases, then that cost is going to go up, and that initial stage of being a public company, that is the most expensive stage. So until you kind of build a track record, until you get some quarters under your belt, that cost will go down. But the sticker shock that I'm sure everyone discussed earlier today on that session, I mean, it's real. I think it's probably even getting worse. Pat, I'm sure you had similar sticker shock.
I wish ours was $4 million. It's super painful. So I would say we used a broker to help us with it, who I thought was very good in not only kind of explaining what is happening with the market dynamics and some of the different strategies, but also going out and negotiating and just be prepared for it and engage early. So that you can factor in that cost. It will come down. I think we're just at sort of a little bit of a peak right now, and eventually it'll come down. And obviously, as you become a more tenured public company, it'll come down. But I don't have any great advice other than just grit your teeth a little bit on it. It's just the cost of doing business.
It's a big line item. Big line item.
For sure.
Yeah, that's fair. That's fair. Well, I will plug, if anybody has questions, please talk to our friends at Woodruff Sawyer, partner at Nasdaq Entrepreneurial Center, and great advisors in this space for all pre-IPO and public companies. So another question on kind of a trending topic we're seeing a lot in the capital markets these days around ESG and kind of the focus around specific initiatives, whether you're checking that box now or if that's part of your narrative and kind of from a go forward basis. But Pat, I might start with you, just given it's likely more applicable to Too Simple, but what's your approach to ESG and what should companies be thinking about around best practices and conveying that messaging?
I think absolutely have an ESG strategy and start thinking about all three letters. I think the environmental part gets a lot of attention right now, but thinking about your social impact and your governance. And so we certainly highlighted the environmental impact of our solution. A virtual driver is 10% more fuel efficient than even the best human drivers. Which is really significant when you spread it across millions of semi-trucks traveling a couple 100,000 miles each every year. So we certainly leaned into that, as well as the safety benefits. And that was neither one of those were sort of artificial. Those were very genuine elements of our story. They're real savings. They're real things that our customers are focused on, and in particular on safety from a regulatory perspective. Autonomous vehicles are only going to be allowed if they actually enhance the safety on the roadways. So, it was all kind of woven into our strategy. But we also really focused on the social element of what we're doing, stuff that sometimes can be, you maybe don't think it rises to the level of being included in a roadshow. So things like we have an education program to train the next generation, or really the first generation, of autonomous vehicle technicians. And we have that with local community colleges in Arizona and in Texas, where we operate. We talked about our initiatives to increase diversity and gender equity within the tech space and within our particular hiring practices. We talked a lot about governance, and look, there are elements of our governance which are, not probably viewed as, we have a dual class share structure where founders have it. And I think it's just being, kind of transparent upon areas that are your strengths, talking openly and frankly with investors about areas that maybe they're not as, aren't probably their best practice, like having a dual class share structure in our case. And just letting people know that you're being very thoughtful, not just as a static element, but these are things that you and your board are continuously focused on, and you will be reporting upon that and continue to improve those. It's just, there's not an option anymore. You have to focus on them.
Yeah, I couldn't agree more, Pat. The only thing I'd add is the European investors that we speak with, it's table stakes. Sometimes they can't even invest in you if they wanted to. If you don't meet kind of some table stakes requirements around ESG, and the US will follow at some point. I mean, but in Europe for sure, it's a no-go if you don't have at least a strategy and how to communicate how you're going to meet some of the requirements.
Yeah, well said, both of you. And I think, Pat, you really nailed it. It's the focus on the three letters, right? Because there's certain things that are outside of your business, and maybe specifically around environmental. So if you have a story there, but you can focus on a governance or the social element, right? I mean, software versus autonomous driving, they're two very different sectors and technologies. However, you can still tell and build a compelling story around what you're doing to hit each one of those letters. So that was a well said point. We've got a few minutes left, so I'm going to queue up this last question. It's kind of a softball, but I guess, Robert, going to you first. Rate maybe this transition from private to public, and is there anything you do differently or words of advice to this next group of leaders?
We're 3 quarters in our public company life. I'd say so far so good. We've been fortunate that numbers we've been posting have been better than we were expecting and guiding to. I get a lot of criticism that our guidance is too conservative but we're an e-commerce business. Last year there was a massive spike in e-commerce. We've got some comping issues of especially around GMV flowing through the platform this year versus last year. So I try to split it out. I try to split out subscription versus the revenue that we get from rev share from partners that's driven by GMV. But I'd rather be called conservative than ever miss a number. So understand that building a track record, I think, takes 12 quarters. We're 3 quarters in, so we've got a ways to go. That's been the toughest part, but nailing down kind of that forecasting model, that beat and raise model, getting really granular in that, understanding how much room there is to set guidance around it, will make life less stressful, if you don't have those things in place.
Yeah, well said. And Pat, similarly.
I would say Robert did a great job of laying it out. Under promise and over deliver, being conservative. I'd much rather be called conservative. Our company's a lot less mature from a revenue generation perspective versus big commerce, but even in us and setting out our milestones around our technology development, making sure that they're ones that you can hit and you can show a clear line of sight all the way through, and you really understand your own business. Use the preparation to really understand where you have higher confidence and where there are risks within your business before you're out there trying to get in and potentially getting tripped up with investors on areas where you have more or less conviction. Sort of treat the year or so that you're leading up to it as a dry run, where you're really trying to figure out what you're going to say with conviction to your investor base. And my last word of advice would be just, there's so many ups and downs. I mean, it sounds like, Robert, you had quite the roller coaster as you went through it, and there's going to be a lot of ups and downs. We broke issue price on our first day in April, and went from we opened it. Our IPO price was $40. We opened it at $41.50, and it went all the way down to $32 at one point at lunchtime. And I was at the Nasdaq and felt nauseous. Legitimately couldn't understand what was happening. And by the end of the day, it closed at $40, and we're up at $46 or $47 today. So there's going to be wild rides, and just understand that life in the capital markets, if you just focus on executing and running your business, the share price and all of the other things that go with life as a public company will eventually come together. But it is new having a ticker and seeing people sort of voting on your company and so to speak for on a minute by minute basis, and just don't get too emotionally wrapped up in where the stock price is at any one particular minute or not.
Yeah, that reminds me, there's a couple of phrases that I remember telling myself regularly over the last 12 to 18 months. Control what you can control. Everything happens for a reason. Because you just don't know what's going to get thrown at you. And one other piece of advice, and looking back, talk about your business through the eyes of your customers. Be able to articulate responses to questions when you start talking to investors with case studies, with customer examples. I think, you could spend 5 minutes talking about a technical response or spend 30 seconds talking about a customer success story, and those resonate really well.
Well said, both of you. Well, that's going to bring us to our time. It flew by. I know you were doing most of the talking, but just for me, even scribbling notes. So I can't thank you both enough for joining us today. This has been, it's been great to see you guys both. And then two, for all of this incredible insight and education for the audience. So got a lot of questions already populating in, so we'll follow up with everyone on those. But thank you both, and thank you all for tuning in. Nicola, we'll turn it back over to you.
Perfect. I can only echo our thanks over here, Jack, Pat, Robert. Thank you all so much for helping us maybe manage through those stress levels just a little bit easier as a result of those great insights that came today. And we're going to focus on controlling those controllable aspects of this. To all of you joining, we have one more session coming up. But before we take a really quick break, just want to call out an opportunity for you to go ahead and identify if you would like to book a session with any of our amazing partners today. We've included a link in the chat box for you to be able to do that. Please go ahead and take a moment if you would like to do that. And then as a reminder, we're going to take a 10-minute break, give you a chance to fill up those coffee cups one last time. And then we will come back focusing on achieving success as a public company. Again, thank you, and we'll see you all soon. Welcome back, everyone, to our summer 2021 IPO Bootcamp. We're delighted to have you joining us today. And for those of you who have been with us from the beginning of this morning, it's great to have you all the way through. Now, as a friendly reminder, we are going to be opening up for live Q&A at the end of this session. So please make sure to submit those questions into the Q&A function at the bottom of your screen. We hope the information provided by our experts so far has both been timely and valuable. And we look forward to staying in touch with you as things continue to progress and your growth continues as well. If you are interested in booking a meeting with any of our partners today, you're going to find a link to do that just in the chat box. So we would encourage you to let us know and go ahead and enjoy this. Now, before we get settled back in, we do have one last poll that we're going to try to use to orient our final conversation today around executing and achieving success as a public company. So I'm going to go ahead and launch this right now. And basically what we're asking you today is to let us know what you're most interested in learning about for achieving success as a public company. Is it around the case studies that can inform and guide successful IPOs during 2021? Are you looking to just close the books in a virtual world? Or learning about the process changes that have been created by COVID-19. I'm going to give everyone just a moment to reflect on that question and answer if you will. And as soon as we see the majority of those coming through, I'll go ahead and close this vote, close the poll, and let everyone have a chance to see how people are reacting today. Interestingly, with tremendous input, we're seeing case studies being an ask for a wide participant base here today. So thank you for all of you participating. I'm going to end that poll and share the results. And while I do that, it's my absolute pleasure to introduce and give a very warm welcome to our final panel for today. So please join me in welcoming our moderator, Katie, partner at KPMG. We have Richard joining us, a partner at Wilson Sonsini.
Thank you.
We have Sarah, SVP and Global Head CFO of Practice at Anaplan, and Praveer, Senior Vice President CFO at DoorDash. So without any further delay, Katie, I'm going to turn it over to you.
Great. Thank you very much. Thrilled to be here and chat with everyone today. I think we have a very exciting panel. I've had the pleasure of working with all three of these individuals on various IPOs and other items. And so why don't we go ahead and get started? So as my picture shows, I'm a partner at KPMG. I specialize in our emerging growth practice, which basically means bringing on pre-IPO companies, taking them through an IPO, and then on to the lovely world of a successful company and SOX compliance. So with that, why don't I go ahead and let Richard Blake do a short introduction.
Hi, I'm Richard Blake. I'm a partner at Wilson Sonsini, where I've practiced for about over 20 years now. And I help lead our public company group. So I spend most of my time advising companies that have already gone public, but I also do a little bit of IPO and capital markets work, and look forward to the conversation today.
All right. Thank you. Sarah.
Hi, I'm Sarah Baxter-Orr. Thanks for having me today. I'm with Anaplan. We IPO just a little bit over 2 years ago, and prior to, I'm actually SVP of Global Head of Solutions and head of our CFO advisory practice. Prior to that, I held several divisional CFOs with a large telecom company. I'm wildly passionate about leveraging data and digital transformation and advancing, the finance teams so they can advance their companies. Again, thanks for having me.
All right. Thanks, Sarah. Praveer.
Hi, I'm Praveer Adarkar, and I've been CFO of DoorDash since 2018. Prior to DoorDash, I led the strategic finance team at Uber, and before that, I spent several years in investment banking at Goldman Sachs. Excited to be here.
Excellent. Thank you. So as everyone can see, we have a very experienced panel here. And I think what everyone really enjoys right off the bat is just hearing the stories, their personal experience with what makes a public company successful, and also those war stories, what to avoid. So in light of that, let's kick that off with Praveer. Obviously, you just completed a highly successful IPO at the end of December, and your company continues to thrive. What do you think are some key takeaways, thoughts with why you have been successful.
Sure. So as I look back on our experience, the three things that I think were particularly helpful to help us adapt to life as a public company. The first was getting the accounting close process exactly right. And, ideally before you go public, you've had a few practice runs, completing the close, producing a 10Q according to a public company timeline. And the reason this is important is not only to ensure that the numbers are accurate, but that the process is fairly consistent and predictable, and everybody knows the roles that they're playing and so on. So that's number one. Second is your forecasting. You want to be comfortable that you can forecast accurately and you can hit your numbers. And this is going to be important, particularly as it relates to the guidance you're going to be providing the street. And then finally, I'll say practice earnings calls. The public call and the analyst and investor callbacks just tend to be a new experience for most people going public. And so use your board, use your investors to practice calls for a few quarters leading up to the IPO.
Yeah, that is music to my ears. As an audit partner, I am very focused and really appreciate just everything that it takes from the very beginning to get a company ready. And what you said, it really does take the whole company, right? It's just not accounting. It is as well as the data, FP&A, your folks in kind of mining the data in the background, as well as the lawyers and your board. It certainly does take a village here to get a company public. And with that thought, Richard, from a lawyer's perspective and outside counsel, what are some thoughts for you on what companies can do and maybe what to avoid?
Yeah, when I think about IPO prep from the legal side and preparation for being a public company, somebody told me once, and it's really stuck in my head, that it's about getting the people, the policies, and the processes sort of nailed down. And Prabir talked a little bit about that just now. On the legal side of it, there's two sort of major changes that I can think of from being a private company to being a public company, where those three words, people, process, policies, need some significant changes and upgrades. One is the board of directors, and so you've probably talked about today already on your panels about how you need to have more than just VC directors on your board as you approach going public. You need to add people with industry experience. You need to add people who have financial expertise and can help serve on your audit committee. You need to have more diversity. One of the things that's coming out, there's a lot of a push, and California actually has some laws that require a certain number of people who identify as females to serve on your board, as well as people from underrepresented communities. And the Nasdaq has some proposed rules out there that would require disclosure about diversity on your board of directors. And so, and by the way, that doesn't change after your IPO. Talk to any public company. Board recruiting is sort of a constant for public companies. They're always looking for new board members because people cycle off and new people need to come on. As well, there's a lot of corporate governance changes, new committees, audit committee, compensation committee, governance and nominating committee. And so each of these committees have a new cycle of quarterly meetings where different things are covered, different governance aspects. And so making sure that you have checklists for what items need to be covered from these committees at different meetings is super important. The other main area that I want to start off talking about, people, process, and policies, has to do with public reporting. Prabir's mentioned that on the finance side about having people who both can forecast your numbers and then get them reported. There's quarterly reporting, and annual reporting that is required, 10Ks, 10Qs. And on the legal side, it's helpful to have people on your legal side, your legal staff, who have experience with SEC reporting. And so often one of the hires that gets made, and a key hire from our world, because we interface with them a lot on the reporting side, is somebody in the legal department who can handle SEC reporting and governance matters, both working with the company, working with the disclosure committee, the finance team, the auditors, but also external counsel and the board in terms of reviewing 10Ks, 10Qs, proxy statements, other reports that are made. Those are sort of two big areas of change. The companies that I can think of who've done well at that are ones who start all those processes early and start board recruiting, start filling out the finance team, the legal reporting team function early, and those who struggle are ones that sort of throw it together at the end, or maybe after the IPO as well. So word to the wise: don't pay short shrift to these functions. Get them in process early.
Yeah, I totally agree with that, especially seeing companies at all different stages and seeing right now a lot of the SPACs who are, going public, maybe a little bit earlier than they thought. Just being prepared is so important. You can't start early enough. So Sarah, your thoughts, you've been at some very successful companies in the CFO and operational CFO role. What are some key takeaways you think of what companies need to do to be successful?
Well, first of all, ownership, transparency, and accountability now more than ever. Aligning the organization around the targets and the metrics are critical. Providing the capability and building that mindset of collaboration towards delivering those targets and continuing kind of that spirit of entrepreneurship is kind of critical at this stage of the business. Connect your strategy to your execution. Make sure you've got the strategy tied to the financial targets, tied to the day-to-day operations, and make sure that the team knows, what those are. And then, kind of along the same lines, communication is paramount right now. Making sure you're mitigating risk and maintaining excitement in the spirit of kind of that continuing passion and commitment that the employees have for their employer as you're kind of going through this growth stage. Create an open dialogue and a safe space. That's going to help in, continuing to keep morale up and dedication. And, we talked about SEC. So really be open about what they can and cannot talk about, now that you're a public company. And to the extent that there's something you can't talk about, make sure they understand why.
That sounds great. Those are a lot of takeaways, and agreed. It is more than just the accounting people that are going to say things. What can you say? Not only once you're a public company, but getting on the road to being public. The training really starts there as well. Sort of feel overwhelmed with everything the three of you have said on what you need to do to get ready. And I think I heard someone say this, that does anyone really feel ready to be a public company? What are your thoughts on that? Like, how do you decide when to go so that you can be successful? Prabir, maybe I'll let you piggyback off of that thought and question.
Sure. To be entirely honest, certainly we never felt like we were absolutely ready. I'm not sure anyone ever does. But the thing that I will say, which you sort of alluded to, which I want to make sure doesn't get lost, is it takes the entire company to get public. And the finance team or the accounting team independently cannot, will that to happen. And so the important point here is you need alignment, not just with the board, but across the management team, that getting the company public is a priority for the company, because there's going to be trade-offs. There's going to be certain roadmap changes you've got to make. We were going to release this great feature here. Now that's conflicting with our, let's call it our data accuracy projects and so on. And so unfortunately, the only way around those types of deadlocks is to have that alignment. And so that conversation has to happen early on. It cannot be simply the CFO or, your head controller or the CAO trying to will that into existence. But that alignment has to exist across product, across engineering, your go-to-market org, obviously the CEO and the board. Because once that alignment exists, the rest of it is smoother. That doesn't mean that you're sitting there the night before pricing and you feel good about being public. Unfortunately, there's always surprises along the way. But the more prepared you are, and you've got the organization behind you, I think you're just better equipped to deal with any challenges that might come your way.
Yeah, definitely. And I think that really dovetails into what Sarah was talking about with respect to that communication and alignment and what can be said. How are there good ways, bad ways to communicate, Sarah, with your team? Especially, I know we've been remote maybe now for 14 months, and I'm seeing people starting to go back to the office, and maybe a little bit more of that water cooler chit chat can start happening again. But what are some thoughts on communication across the organization to get alignment?
I mean, I've always been big on, early and often, in making sure that you're doing as much as you can, top down, bottoms up, in the middle. Make sure that you're communicating and getting feedback from your teams. And I think even being honest with them when you don't have all the answers, because I think anyone right now who says that they have all the answers, we know that that's not even possible. So letting them know the places, here's the answers we do have, but here's some spaces that we're still evaluating, and we're going to keep you up to date as we learn more.
Sounds good. Yeah, and Richard, the lawyer in the room. What are some things we need to be careful of? Are there some pitfalls that you were surprised by in your career to see a company do, or maintaining the anonymity of it, but some thoughts there?
Yeah, well, one thing I just want to touch on that follows up with what Prabir and Sarah have both said. Yeah. So Catherine and I actually worked together in taking Anaplan public a couple of years ago. It was while I was at another law firm that I did a brief stint with. But I remember sitting down, even with the previous management team that is even at Anaplan now, and they said to us years before, they were really thinking that they'd be ready to go public. Like, we know that this is coming down the road. We need to be prepared for it. And we sat down with Catherine and her team, and we came up with a long presentation that we ended up giving to a bunch of the folks in the legal staff and in the finance and accounting staff, and having frank conversations about, where are we in readiness? What things need to be done? What are the long poles in the tent that need to be focused on? And one thing that Anaplan did really well is everybody knew, and everybody was working towards, incrementally towards those steps. And so even though, we worked for years to get Anaplan ready, and a lot of it always happens at the end, but they knew what they were in for. They knew sort of what their strengths and weaknesses were and what needed to be worked on when. We all had a clear understanding of what we were working on at what time. The one thing that I think, if I think about every IPO that I've ever worked on, I worked with dozens of public companies, something is going to happen along the way that's unexpected. And sometimes it's really bad and may cause a delay, and other times it may just be a hiccup. And sometimes it's in the middle. And so one thing to keep in mind is you just got to be prepared for the unexpected. And if you have good advisors around you, a good working group, where there's good interaction and a good amount of trust. And by the way, this is true during the IPO process. It's also true after the company's public. Stuff happens. And if you have that open communication and lines of trust, usually you can work through all of these unexpected things that happen and the glitches that come up. And so expect the unexpected and be ready. I think the people who think that the pitfalls that Catherine are talking about are when people don't do what Anaplan did. They sort of, leave it, we need to work to build the business only. We need to, and that's important, obviously, crucial. Can't go public without a good business model and without returns that are coming in. But as well, you need early in the process to sort of sit down and take stock of yourself and say, where are we and what improvements do we need to make? And then just start chipping away at that.
I think the one other thing I just thought of, is worth adding, particularly to management teams that are going public, is, maintain let's call it a sounding board of other companies that have gone public a little bit ahead of you. And the reason I say that is because you'll have a lot of advisors at your disposal to talk through some of these issues, but sometimes there's no substitute for other managers that have gone through it, because people will often think of situations that might feel like they were unique to them, but you've got no idea how generally applicable it is. And so, going through the process myself, there were several companies that had gone public ahead of us where I reached out to the CFO, to the CEO, GC, and others, and just had them be a sounding board whenever I had ideas or thoughts that you get a company perspective on. And so that I just think it's an invaluable source of information for other people that have lived through a similar experience as one that you're going through, and it helped me figure out what was truly important, because it's overwhelming. When you get when you go through these IPO readiness checklists, there's usually like 1,000 items on that thing, and you don't know where to start. And so just getting somebody else to help you, so say, look, this is important, focus here, these things you'll get done, you can hire advisors to address it and so on. Just focusing your energy and attention, I thought was most useful as we went through the process. And that sounding board played a huge role in it.
Prabir, can I ask you a related question? As you were talking earlier, one of the things that struck me was, one of the decisions that companies have to make when they're going public is what key metrics they're going to talk about with investors. How are they going to sort of frame the company and its business and help investors understand how they should be thinking about it and valuing the company and evaluating the company going forward. How any thoughts that you can share with folks on how to come up with the key metrics, or how you think about framing the company's business and because the IPO is a big sort of premiere of the company, but then in the world that Catherine and I live in, reporting after the fact too, that's what we're stuck with is sort of how you framed the company. And so tell us a little bit about how you guys decided how to do that.
Yeah, so I'll say two things on this. The first is, whatever you do, avoid creating a set of internal metrics and a set of external metrics, because that's a guaranteed road to having a problem in some quarter down the road. You have to be able to, if you look at A, B, and C, and that's what the entire company is focused on, optimizing or maximizing, your external metrics should be that list or some subset thereof. And oftentimes it's very easy to, when we went through the process, I spent a lot of time looking at other comparable companies, looking at what they were reporting, and sort of saying, well, if they're reporting this, why don't we report the exact same thing? And, upon reflection, it finally occurred to me that, well, I can't ensure an outcome on this metric because as a business, we're not managing that metric. So that makes that metric, just unacceptable for us. And so the metrics you report externally have to be whatever it is that you manage the business to internally, and you can decide where to draw the line between, is it all of the above, is it some of the above? That's point number one. Point number two, most private companies with the pace of fundraising nowadays have a lot of crossover investors. These are investors that do both public and private investments. Use them as a sounding board. So what we did was we spent a lot of time with our investors understanding how they were building their models. We would share data with them, obviously, with each quarter, and then we would sometimes hold back certain types of data just to test, what is this person going to do without that data? Is it going to completely break the model, or can they find a way around it? Are they using the rest of the data I'm providing in order to approximate that missing piece of information? Do I need to enhance my guidance on it and so on? So you've got the perfect set of people to test with, because this group of people, by the way, they're public investors and they're at your disposal. So you can experiment with them and find that sweet spot. But again, time is key. If you're thinking about this question a week ahead of the roadshow, you're probably too late. Ideally, you've been sort of working on this question for several months heading into your first filing and so on. But there's more resources than you might think otherwise that are at your disposal that can help you answer the question.
Yeah, that was a great question. And Prabir, in all the IPOs I've done, you did a fabulous job of really soliciting feedback from your advisors when you were talking about the comparable companies to make sure as you moved forward that there was consensus and that you were in a sweet spot, and the company was, both enabling a successful IPO and a successful company afterwards.
And I'll give you one example that occurred to me, Kitty, so most companies guide to revenue. We don't guide to revenue. And that was one of those metrics where in the beginning, when we were just sort of pulling from comparable companies, let's guide to revenue because everybody else does. And then it occurred to us that we don't actually manage the business that way. And so we guided to a different top line metric, not to take you through the history of DoorDash, but that was a choice we made there was a reflection of the decisions we make internally to manage the business. And so those metrics have to be a reflection of how you operate the business. Otherwise, you're going to be at this fork in the road where you might end up making a decision that doesn't optimize that metric, and then you're forced to miss. And there's all sorts of bad things that happen when you miss guidance.
And by the way, Prabir, what the words that you just said, the metrics that we use to manage our business, that's the definition that the SEC has of what a key metric is. And so if there are metrics that you're using to run your business that you're not disclosing, the staff's going to ask you about that through the IPO process and beyond, and they're going to say, hey, why aren't you disclosing this? And if they find out that that's how you're running your business internally, there's going to be some fine pointed questions they're going to ask about that.
And by the way, you reminded me of something. In fact, when we went through the back and forth with the SEC, because the SEC has reviewed other companies in a similar space, and so they often asked us, why aren't you reporting MAUs, or monthly active users? And engage with the SEC. A lot of people, like the first time we got that letter back, I wasn't sure what to expect. I was like, does this mean I'm, in trouble? Like, you just don't know what to expect if you've not gone through the process before. But they asked for a call, and that call was actually, it opened up my eyes, because, by the way, we took advantage of that call, and then actually on subsequent issues, because now I felt like we had a channel to the reviewer. We set up calls to discuss other comments that we received through the process, and I actually found them to be reasonable, because it gave me an ability to provide color, which is just not possible through the response letter, because the response letter is 5 pages long, and it's maybe 5 sentences. The color that you can provide in a live conversation with someone around why you do or don't do something is invaluable. So don't let it alarm you if the SEC asks for that call. Actually take them up on it. It might be an opportunity to educate them and frankly accelerate the review process.
Good point on that. And one thing I think, as I've seen with successful companies, is that there is a strong team at the company in the individual areas and processes. And I think, Richard, you said people. And so, Sarah, I want to direct this question. How do you retain people and get those strong individuals who are going to support the company the goals to make a successful public company? Especially today, there is a war on talent right now across the country. What are you seeing?
For sure. I mean, let's start with retention, as we're definitely in a place where, talent and skills are in high demand. You need to have a better understanding of your culture. And it's critical for like the visionary CFO, as culture can be one of the biggest barriers, to change and to retaining talent. Taking the time to understand how success is defined, how resources want to be rewarded, how do they want to be recognized, where do you have a set of strong skills, where do you have skills gaps, and really, kind of developing your investment thesis about, what are we going to invest in next. This is an opportunity to expand the team's talent, commitment, and ability to deliver in an efficient way. And I'm big on data. So I often say that, data science is no longer a department. Everybody needs to get on the data science train. It doesn't mean that everybody needs to learn how to code, but I think in the organization, the leadership team and all of the other groups need to understand how data can, really advance the company, make you effective, optimize. And there's a lot of actually untapped opportunity in your organization. You'd be surprised where you might find people that have a lot of, data capabilities and can harness that data to really come up with new, creative ways for you to, run the company. And think about your investment in your next wave of leaders. So as an example, at Anaplan, we're partnering with a company called Correlation One and their Data Science for All program. We're deeply engaged with them, and we basically worked with them in developing young, bright minds who have a passion for data science and a desire to learn, but might not have access, to that type of education. So we've even hired a number of these data scientists, and we've also helped them get connections, in our ecosystem. So like taking on initiatives is really critical, and will help you make a dent in the talent shortage overall and set your organization up for success.
Yeah, and what you said there, I think, is really key, is that you need to develop the individuals, that the people aren't necessarily going to just be there and show up on a resume that you get to hire. And so the leadership of the company and developing the people in order to enable the entire company to be successful, I think is so key. And since they're not there, you got to find ways to get creative. I certainly think you have at Anaplan. I think it's fabulous. Learned a lot from you on that over the last several months. And Prabir, here we are in a new world these last 14, 15 months. I've seen people, working from all over the country. How are you seeing that war for talent, and how are you ensuring DoorDash is successful in kind of the new environment?
One of the few silver linings of during the pandemic is it really opened up the aperture on recruiting. So prior to the pandemic, we were largely hiring in a few major metro markets like the Bay Area and New York. This location constraint was eliminated during the pandemic, and we actually found some excellent finance and accounting leaders across the country. And so, as offices reopen, my advice to leaders is to continue to remain open to a location agnostic strategy, because you might be surprised about what you find. We've got accounting people in Hawaii, we've got finance people in Idaho. They're all over the place, and we're creating more hubs than we otherwise would in order to get access to that talent. So hopefully, I think of it as moving with the times. And we plan to continue hiring as broadly as possible just to stay ahead of the talent curve, because the Bay Area is getting incredibly competitive and expensive.
Definitely. And Richard, legal perspective, what do companies need to be worried about when they're going out and trying to find all these resources to build and maintain a successful company?
Yeah, so a couple of thoughts there. So traditionally, obviously, anybody who's lived in California for long knows that, non-competes are against public policy here. And so movement is very easy. It's easy to change jobs. And so that even exacerbates the talent issue more, because it's so easy to switch from one company to another company down the street doing something that's similar. I think, again, people, processes, policies, I think most companies do a pretty good job of working with employment lawyers to make sure that as new people come on, that they respect the confidentiality obligations that they have to former companies, and that they don't bring along confidential information, trade secrets, other things like that could get their new employer into trouble. So making sure that those policies are in place is important. I think the other thing that now that we're seeing exactly what Prabir mentioned in terms of looking at other geographies and allowing people to be employed in different states, that does require companies to take a look at whether they're now conducting business in those states, and whether they need to pay taxes and employment taxes and other sorts of income tax, other things. So it puts a little bit of a strain on the HR function and on the finance function that's dealing with those sort of tax issues. But those are important things to do because states are going to be looking even more, I think, at these issues of a mobile workplace, and making sure that where you have employees in a certain state that you're paying the taxes in that state as appropriate. And part of the challenge is that employees are a little bit fluid, and so they're in multiple states over the course of a year sometimes, and so just trying to keep that on track and keep your eyes on the ball there, and make sure that people are telling you where they are, so that you can handle things appropriately is a little bit of a challenge that I think we were not used to focusing on such things as much as we are now. But now that people are more mobile, it's something that we just have to look at and keep our eyes on.
Kitty, can I add one other thought?
Yeah.
The one thing that it's just a fact of life is, the IPO is a liquidity event. And for a lot of people, particularly who've been with the company while it's been private for several years, it unlocks a certain amount of wealth that can, sort of change their priorities, certainly in the near term, right? And so it's super important to, and I know you and I have had this conversation multiple times, but it's important to see that coming. And you might not be able to observe or spot specific people that might be, might have different intentions, but it's important to plan redundancy. And so try not to get, caught by surprise. Expect a certain level of attrition, which again goes back to hiring up early. And that might mean be flexible on geography. It might mean bringing on more people. It might mean being flexible on compensation bands. In fact, as a public company, you have to sort of revisit everything that worked for you as a private company. But you have to put in the time to figure out, and go person by person to figure out, if this person were to leave, what's my backup plan? Because there's some probability associated with their departure of the IPO.
Yeah, and I can say that conversation comes up in every single audit committee I have with my public companies is, where are we at risk? What is going to happen if X and so leaves, and how strong is our bench? Every quarter I have that conversation. It's a focus. And I think what I've heard from the three of you, it's now time to be creative. It's probably been that way for the past year. Sarah is talking about correlation and training people to actually do the job because they're not there. Prabir hiring different, locations. And Richard thinking about who is out there and the creative, they're going to live in 3 states. How do you comply with payroll tax in the 3 different states? And Sarah, you brought something at the beginning with respect to, I think, different people may want to be compensated in different ways. Can you expand on that a little bit? What maybe you're seeing with, I'll say it this way, I'm probably on the older side, the generations, the people that are 20 may not want to be compensated the same as those, a tad bit older than that.
Yeah, I mean, definitely it could be, like the option to remote work. It could be the flexibility of the hours. It could be, how often do I have to go on trips? There's so many, when I often refer to what, when I look at jobs as the happiness matrix, it's more than money. There's a combination of elements. Do I respect the people I work with? And is the work that I'm doing being respected? All of these elements go into, if your talent is wanting to stay. So you've got to consider all of the non-monetary aspects of, of talent retainment.
Yeah, and we're seeing that as well with respect to individuals really wanting to think about the larger environment and how is their company contributing to kind of the ESG roles right now. And you've got different companies that do a really good job of telling their story, and I think they're good at hiring people. You've got other companies who are very focused on the ESG, but maybe just don't even communicate to the street in their filings. Therefore, it's not as prominent. And that is also having an impact on retention and just hiring folks, because they are, many individuals, I think more so than ever, are looking for the greater good and how to contribute and give back, not only to the company, but the wider environment and socioeconomics that we're facing today. Definitely an interesting time that really comes back to all the aspects of, I've been calling it the war on talent, and how do you keep them, retain them, to enable a strong company growth and successful public company.
Yeah,
thank you. Yeah.
Employees are going to want to see the walking. Talking's great, but they want to see the walking.
Yep, you got it. So yeah, so I know we've chatted a lot about the IPO process and how to build sort of your successful company with employees, as well as communication with the board. Richard, what are some practical ways that you think public companies can avoid trouble that maybe you've seen before, and or you wish someone had asked you and you could share that with them? Here's your chance.
I think most companies do a pretty good job of staying out of trouble.
Okay. Yep.
We don't have too many companies that are are really, by the time that they want to go public, there's not too many companies that are trying to, to actively commit fraud or have problems.
Yep.
I do think, I think taking the time to work with your advisors and get things set up early can be super helpful, and just cause the processes to be smooth. That's one of the advantages of the IPO process, frankly, over the SPAC process, I think, is that the IPO process, and it takes a little bit longer, and you go through this drafting process and this revision process even before you file your S1 with the SEC, and then you go through the comment process with the SEC, and there's a time period there in advance where you're working with the auditors to get things over a rational time frame to get your past historical financials audited, and to prepare for the quarterly financial reporting that has to happen, that typically doesn't happen with a private company but ends up needing to happen with a public company. And so there's a time, and sometimes the IPO process is compressed, but sometimes it can start and stop and take a little bit longer. And so there's a time process there that sort of gives everybody the ability to put processes in place so that once the company is public, they can close their books in a timely fashion. They can work with their auditors to get things reported. And sometimes, frankly, it just takes money, and it takes a little bit of time to get things set up right in the first place. If you avoid trying to do shortcuts for things, then you're going to end up in a better place down the road, I think. So.
Yeah, definitely on that. Certainly, I was reading a speech from the SEC about a month ago that came out on the SPACs, and they came out and basically said, you may do a SPAC, but you still have to operate as a public company, and the advisors, whether that's your auditor, your lawyer, and their company needs to be ready on day one to start operating as a public company, even if you're able to get to that point in a condensed time frame. Doesn't change the end game.
I think that's right.
Yeah.
I mean, as Prabir suggested, like the most successful companies are ones who start acting like a public company well in advance, having earnings calls with members of their board or with certain investors where, they have the chance to field questions. They have a chance to sit on the hot seat and take the flak, and describe what they're, why the company's financial results were what they were. And so I think, taking that time and starting to act like a public company in advance really pays dividends down the road.
Yeah, completely agree. Sarah, from your perspective, we've got quite a few folks listening in, who are pre-IPO or maybe newly public. Are there some key items you wish you had known, kind of ahead of the time as being the CFO and operational CFO? Some advice to give these folks? Oops, looks like you're on mute. Famous word these days, right? I think say that 10 times a day.
I got to do that rookie move at least once.
Yeah. Well, I didn't have my camera on at the beginning either. That's another rookie move. I figured that out in the first couple seconds. So yeah, please.
I still might go to what I would call maybe the new basics. At a recent Gartner CFO and Finance Executive Conference, the keynote speaker highlighted the fact that leaders right now are not talking about going back, to the old normal, and we know this, and they're not even sure they're going to go back to the next normal. They're recognizing that they were exposed during the pandemic, and they're evaluating those risk areas, and they're figuring out how do they become better. And these leaders are actively looking for blind spots and trying to make sure that those get addressed. And it can be from, your talent to your technology. It could be your digital transformation. Listen, the technology is there, so making sure you're taking advantage of it, securing your data, super critical, and collaboration really more important than ever. I think that, traditional roles and the traditional persona that goes with those roles needs to be, reconsidered. The CFO can't be the only person in the room worrying about risk. The CRO can't be the one like, oh yeah, I'm going out there, I'm the risk taker. Everybody needs to lean in and just radically collaborate, in order to meet, the shifting and things have not been operating at this pace of change, maybe ever. So that radical collaboration is going to be critical. And I think even that cross-functional collaboration, and we talked about this in the beginning, those metrics, pick those few metrics that are going to really matter. These are the 6 or the 10 metrics that when our company meets these metrics, we achieve our objectives. And when everybody knows what those metrics are and they're marching to them, I think you really get some amazing benefits. So, it's just, and then lastly, I would say that you need to over communicate. I don't think I could emphasize that enough these days. Over communication is critical, especially because there are going to be further unknowns out there that we didn't face, say 3 years ago. So I think just making sure that there's radical collaboration is critical.
Yeah, no, I'd agree with that, especially as I think people are going to be working in different locations, continuing whatever this new normal is going to be. I think we've all seen in our daily lives that email communication, things are misinterpreted, that active over communication, getting on a Zoom call like we are and having those conversations will enable the entire organization to move forward and reach those key metrics. And as Prabir said, they need to be the same, internal and external. You can't have two sets. It's too much to track and not really legal with the SEC, as Richard said, really key there. And piggybacking off something you said, Sarah, on the innovation, that is something when I read, what are boards concerned about, CEOs, it is that innovation. How can I innovate? How can I not only innovate my company and keep up with the changing and the disruptors, but that goes to your employees and the individuals you're hiring and ESG and everything. It's much more holistic today than I think it was, even just a couple years ago. So Prabir, you've now been CFO of a public company for what, 6-7 months now. What do you wish you had known back maybe on December 7th, day or two before you guys priced, that you've learned maybe in the last 6 or 7 months?
Yeah, maybe not the day before we priced, but it was a slow realization that sort of crept in as we were approaching the IPO. I underestimated the demands on finance and accounting as a result of being public. And so my advice would be to build out the team early, hire more than you think you need. Especially in these hypergrowth companies, the scale and the complexity grows pretty quickly and the finance team can be caught flat-footed. So the only way around that is to build a team that's sized not just for your scale today, but to think about what your scale and business profile might look like 12 or 24 months out and build for that. It's just going to save yourself a lot of the challenges that you're likely to encounter, because the work only increases when you're public. It actually doesn't get any lighter.
Yeah, and on that note, and we've been talking about this and talked about the Anaplan, is once you're a public company, you then get to report under Sarbanes-Oxley 404, so internal controls. And you might get, a year break before you have to do that, if that, but that comes close right after a public filing in many situations. And you think an IPO is the entire company. Sarbanes-Oxley takes it to a whole new level of involving the entire company, the resources and the meetings and the additional time commitment. I hear companies say adding Sarbanes-Oxley is another 20 to 30% of people's time just to document everything they do. You're sitting here smiling at me because I know we've had a lot of conversations.
I'll tell you one tactic would be, I'm not sure many CFOs will have the choice, but to the extent that you got a choice between going public in December versus going public in January, pick the January option. You get an extra year to be SOX compliant, which, in theory, I knew that. I'm not, again, I'm not sure how much of a choice people will have, but if you do have a choice, buy the extra time.
Yeah, no, we joked about that ahead of time. I think I asked you to go in January and you just kind of You don't really have the choice. Both, yeah, DoorDash and Anaplan had the pleasure of needing to be SOX compliant that first year. Yeah, that is a fun time.
We like challenges. So.
Yeah, yes. Makes life interesting.
Exactly.
Yeah. Richard, what are your thoughts? We haven't talked much about Sarbanes-Oxley. I do know that a successful public company, you've got to be ready with your internal controls and really be ready for those CFO and CEO certifications. Like, unfortunately with DoorDash, within pretty much, less than 13 months.
Yeah, I guess I'd say a couple things. A lot of companies worry about in the IPO if they've had an internal control material weakness in the past. And there's a number of very successful IPOs that have disclosed a material weakness in their past historical financials. That is not something that's going to keep you from having a successful IPO. So just keep that in mind, that as a private company, if there have been missteps or issues or problems or lack of appropriate personnel or controls that didn't work, and you end up disclosing material weaknesses, that's not something that's fatal. And then it's just a matter of, again, as Prabir and Catherine mentioned, sort of understanding, okay, and sometimes like we don't get to choose when we go public at some level because the window's there and we need to take the opportunity. The price is right, the window's there, we need to do it, and we'll let the chips fall as they may when it comes to other things like when we need to, file 10Ks and reports and when we're subject to internal control Sarbanes-Oxley compliance. But that said, having a clear understanding, working with your advisors and knowing, look, this is the schedule for when we're going to have to handle our internal controls. And by the way, the way that the emerging growth company definition works, at the same sort of time that companies are going to have to be complying with Sarbanes-Oxley internal controls, they're also having to report more in depth on their executive compensation disclosure. The two, in many respects, go hand in hand. And so there are multiple sorts of changes that are happening. And so just working with your advisors to understand and know when things are supposed to be happening based on when you went public and what your current market cap and your emerging growth company status is really important, because then you can prepare in advance. Again, if we're talking about case studies, the companies that I've looked at who have had the most successful Sarbanes-Oxley implementation are the ones who, even before the IPO, sort of understand, okay, if we go public at this time, this is what's going to happen. And they start working with advisors about, this is when we should be starting to do certain projects, and this is when we need to start documenting, and this is when we need to start building things out, even before the IPO. And so just as has been mentioned, there's 1,000 things on the IPO checklist. This is one of them to understand and get your arms around, and just know that that in addition to all the other corporate governance and financial reporting changes that you're making, at some point you're going to be subject to SOX, and so figuring that out and getting an advanced work plan. The companies that have been less successful are the ones that are, like, we hope that we'll keep our emerging growth company status for longer. So we're not going to do anything about it until we absolutely know that we're forced to do so. And then they're scrambling. And that can be a real challenge, and can result in less favorable outcomes. So.
Yeah, that preparation, whether it's the IPO, the successful company, and Sarbanes-Oxley, I think has been a general theme and discussion through this entire panel, and really looking ahead and looking around those corners. What do you need to be thinking about next, and ensuring you have enough qualified people either locally or virtually, or you need to train them up and go find them in order to enable that successful company. One thing I've also seen, especially in Sarbanes-Oxley world, is that IT function. We've talked a lot about, and I think next time, we need to have a CIO or someone on one of these panels, is that it is more just the accounting, the lawyers, the KPIs. It is your data. It's your IT function. It's your engineers on the back end. And I think they get a little involvement kind of in the IPO, maybe with those KPIs and making sure the data's there. But that is one area that needs to grow significantly post IPO, especially headed to SOX. So yeah, and obviously I think we had earlier panel, the D&O insurance, making sure that is well maintained and thinking ahead of that. I know we've been having some conversations as how is this D&O insurance going to look? Will there be a difference with the companies that had the IPO, had the time to plan versus kind of what we're seeing in the SPAC world? And is there going to be a change with just some acceleration of needing to be ready to operate as a public company? I think time will tell, but some of that communication from the SEC has certainly made me think over the past couple months. So we're about to kind of head, oh yeah, go ahead, Richard. Yeah.
Catherine, can I just mention one thing on that? So, you know, I'm a corporate lawyer. The last time that I stood in court was when I was, you know, sworn into the bar. And I don't go litigate cases. I do my darndest to help work with companies to craft disclosure that's going to keep them out of court. But it can be an inevitable thing. You know, just sometimes the market falls for everybody. And when that happens, you know, companies that go public often are the subject of securities fraud litigation suits. One thing that we try to do is make sure that our companies are introduced to securities litigators early on in the process, even in the IPO process, so that, you know, we work with the companies, you know, all the time in the IPO process as corporate lawyers. They see us a lot. We have interaction with their legal team, with their finance team, with some of the people on the business team, IR team. But at some point, inevitably, something's going to happen and you're going to end up getting sued. And having those relationships with the securities litigators and having them, you know, speaking with senior management, being in front of the board so that the board understands and knows who they are, that can be really important when, you know, that bad quarter happens or when something else happens where they end up getting sued in a lawsuit, so that there's already the relationship of trust there. So that's something we try to do in advance, so that there's already a relationship and the company knows, hey, look, you know, this is how we're going to proceed, and this is, you know, we've been sued. This is what's next, and this is how we're going to respond, and people can move forward and with confidence that you know the litigation is going to be handled well and that they're going to be defended appropriately. So.
Yeah.
The one thing that as Richard was talking, it occurred to me that one of the things that our audit committee made us do, which I thought was, you know, a good exercise was, and Katie, you remember this, was to take these potentially corner case outcomes. What happens if your earnings leak before your earnings date? What happens if something's materially incorrect and so on? And build playbooks around how you would respond. And the idea is not, it's to make sure you know who's getting that call, when they're going to get it, who's on point, which advisors are you calling, what's the sequence of events in order to respond. And I think just the act of going through that exercise, at least for me, solidified that, look, you're going to do your best to prevent that outcome, but just knowing that that plan exists on the shelf just makes me feel a little bit better about life. And so, you know, it just comes down to preparedness. I mean, everyone's, you know, hoping for the best and making sure that nothing bad happens, but in the event it does, you want to make sure you have a plan to react.
Yeah, key theme today, being prepared, looking around those corners. Yeah, and I do remember, I think someone's going to be calling me at 2 a.m. at some point.
I hope not.
Me too. That's what I think every client, when they do this, they say, well, what happens? Who are you going to be calling at 2 a.m.? I'm like, can we just make it like 10 p.m.? We're going to have a disaster. Let's just have it, you know, when people are a little more awake. But yeah, no, definitely. Thank you. So we are going to open it up to Q&A in just a minute. Want to give the panel last chance just to offer a piece of advice, maybe a nugget that you thought of today, or you expressed already for a successful public company. Why don't we start with Sarah?
Well, I would encourage everybody to, while this is extremely serious, have fun along the way. Make sure your teams are having fun. So, the experience is also worthwhile.
I would agree with that. Yeah, Richard.
I'm gonna second and concur with what Prabir said, and that's spend a little bit more money and a little bit earlier to sort of pull together the finance and legal resources for public reporting. Because if you know you're going public, we know we're going to need these things. Get it on board, get it settled. Because a lot of people just throw it together at the end, and it's always better to have more time to plan and prepare and get the policies and procedures and process and people in place. So I'm going to second that. Well stated, Prabir.
All right, Prabir, takeaway from you.
I think it's just practice. I mean, there's so many things that are new when you're a public company that the more things that you've, let's call it dry run or just done a dress rehearsal for, it just reduces the uncertainty in your own mind. So the more practice sessions you've had on whether it's a close, whether it's earnings, whether it's writing the shareholder letter or the press release, or getting together to figure out what's in your MD&A, it just reduces that basket of things that are brand new. Because there are going to be things that you didn't anticipate. There are going to be things that are unexpected. And you just want to free up your brain to focus on those new things versus making the entire gamut brand new. And so to me, by the way, no one feels like they've had enough practice. So if you're one of those people that is sitting there on the eve of the IPO worrying about, I only did this once, that's okay. That's okay. But the fact that you did it once, that's one more time than zero. So it's a good start.
Yeah, good point. I would agree. All right. So I think it is time to open up to some Q&A to the audience. And so you can go ahead and submit your questions at the bottom of the screen through the Q&A function. Go ahead and give people a minute or two to submit some questions, and go ahead and see if we can bring any more clarity to this. All right. So one question that I'm seeing come through, direct this one, I think Prabir, this one can go to you. What was the best moment during the DoorDash IPO for you?
I think our experience was a little non-traditional. To be entirely honest, I was looking forward to the whole, you're at the exchange and all of those things. We didn't have that because we were right in the middle of the pandemic. So in some ways, there was an hour of celebration because you got the CNBC going and you got the virtual bell ringing and so on. But then literally at 10 a.m. I was back to my day job. And so, it was more muted than one might expect. But and this is a funny anecdote which I tell my wife about. I got more congratulatory texts and email messages that day than I got ever in my life when I got, just more emails congratulating me even compared to when I got married or when we had a child. So it's your moment in the sun. Enjoy it, as Sarah said, and you'll only do this once or twice in your entire career, so it's pretty special.
I would agree with that. Here's direct this question to you, Sarah. How do you prepare for or manage potentially missed targets, negative research, negative communication?
Well, I would go back to, what the gentleman said about scenario planning and making sure that you have playbooks for those. Also, when it happens, you've got to make sure that you're able to address it honestly and what does that mean going forward? How are you correcting? Is it being played out to be more than it really is? But making sure that you've got a plan to address it going forward, and that you're transparent in what's going on with that.
If I can just add to that, Katie, there are companies that want to avoid being too predictable. So investors are smart, the sell side's pretty smart. They look at your guidance and see where coming in every quarter, and then they sort of know where to haircut it or where to add a premium to it. So there is a strategy. I'm not suggesting people adopt this en masse, but there is a strategy where companies will strategically miss every now and then. So just, it's not the end of the world. So the answer, as with most things in life, is it depends. It depends on what caused the miss. If there was an awful execution error, a different story, you got to go fix that. But sometimes you want to make sure you're managing the street and you're preventing expectations from getting too far ahead of themselves.
Good point. All right, I think the last question might be a team answer between Richard and Prabir, and that is, how does a CFO work with legal counsel? And I'm going to direct it to you, Richard. How do you work best with a company? And then Prabir, I'll get your reaction to that.
Wow, putting me on the spot.
I know.
We're pretty flexible. we're pretty flexible with the way that CFOs and working groups want to work with us. I think sometimes, we just end up having open communication about roles and responsibilities. In the IPO, it's all about, okay, well, who's going to draft this thing? Who's going to handle the risk factors? Who's going to draft MD&A? Who's going to draft this part of the business section? And so, just sitting down together and figuring out on the time and responsibilities checklist, like who's responsible, what are their expectations about for different things happening. And I think the best thing is just when there's open lines of communication through email, through phone. I don't mind when, a CFO or a general counsel or somebody calls me up out of the blue or sends me a quick text, hey, can you chat for a minute? And I like that open lines of communication. One of the things we did it actually with Anaplan, and did it with the Etsy IPO that I worked on many years ago, did it with one called Cricket that we just did. I'm guessing that DoorDash did it as well, because my partner Rezwan, he's a big fan of this, is having a weekly check-in meeting where we can't, like, we always know it's on the books. We're going to go through the checklist and make sure that we're all tracking for the things that we need to be tracking on. And having that sort of once a week dedicated session allows us during the week, to then communicate real time on things that we need to be communicating with. So, Prabir, how did I do? You can correct me.
No, that was spot on. I mean, I will say, look, Rezwan Pabri was our lead partner from Wilson Sonsini. Wholeheartedly recommend him 20 times over to anybody that would ask. And we obviously had a relationship even preceding the IPO, and he's someone I continue to sort of look to as an advisor on all matters legal and frankly even strategy to DoorDash. But the key point here is, I think, remember, your lawyers have seen a lot of these iterations. They've seen a lot of them. And unlike with the banking model, where oftentimes you're working with the analyst or the associate, with the law firms, you're actually working with the lead partner. And that lead partner is likely seen and been in the trenches on hundreds of these situations. And so use their experience as a guide, because even when it comes to things around pricing and dynamics around the green shoe and dynamics around lockups, you have to understand the conflicts that are inherent in these processes, but the lawyers can be your friends. And so recognize the power of that experience and draw upon it, if for nothing else than to ask the right questions as you go through it. And so I wholeheartedly recommend, sometimes some companies do run an RFP or a bake-off for corporate counsel, where the GC runs it exclusively. I'd encourage that the CFO be involved, because, I probably spent 50% of my time talking to Rez through the process, just as much as our GC did. And so don't underestimate the strength of that partnership and how valuable it will be as you execute the IPO.
Excellent. Thank you. Well, thank you to the panel very much. You can turn it over to Nicola.
Thank you so much. And we can only again echo our thanks for all of your time today, appreciating and recognizing how much has gone into making this conversation so helpful, not just for those currently going through the process, but those that are planning on how to do it successfully. To all of you who have stayed with us throughout today, thank you. Your time and your feedback is really a gift to us. And on that note, we are going to ask for just one last favor before you leave, and that is to please let us know how we did today and what more we can be helpful with as you start to plan through this next chapter of your own development. So you'll find that link to that survey in the chat. Please do take a moment and complete that and let us know how we can better serve you as we go forward from here. Again, to our partners and to all of those joining us, thank you so much, and we will look forward to seeing you again very soon. Take care.